today, at least we need at least 2 meetings to finish what you are supposed to know, to do our revision before the exam. So after today's meeting, you schedule another day and meet within the week and have our last revision of the things that we won't be able to discuss today. So at least we need 2 meetings to be able to finish with the revision. Now, for advanced audit and assurance, normally you see the...
Sir, please, the documents you are using, you've not shared on the platform.
Oh, this one is on the platform. This one is the exam format from the ICAG. This one is on the page. Yes.
Because I'm not seeing the document for this evening. Okay, thank you.
It's on the page. Even my own, the revision question I've put together is equally on the page. And those ones, I tried my possible best to provide likely suggested solutions to them. That one is equally on the page.
Okay.
The one I'm projecting currently is the exam format from the ICAG. The exam format from the ICAG. So we'll go through it briefly. We'll go through it briefly for you to know what is expected of you before you sit for the exam. Basically, advanced audit and assurance, you will see it to be an easy paper because basically it's full of theory, full of reading, full of writing. So you see it to be an easy paper, but it's not easy. There are technicalities in answering the questions. The questions are real cases, practical cases that they'll give you for you to answer. So if you want to just use your English mind to answer the questions, you won't get it right. So you have to know the technicalities, how to approach questions for you to get the maximum mark. That will number used to get your 50 marks to pass the exam. So we will do the exam format. We know the structure of the exam already, the question structure, how the question will come. But we will go through each of the structure, each of the way to know under each of the way, these are the things we are supposed to know before we sit for the exam. We do this maybe roughly 1 hour. When we are done, we take general questions. Then we start with the questions I have in the intervention document. Now, advanced audit and assurance, the old syllabus and the new syllabus, there is not much changes in it. There is not much changes in it. Under the new syllabus, we have corporate governance. So I can see on authority that corporate governance is even though we have corporate governance in the old syllabus. We have corporate governance in the old syllabus, but it was under regulatory environment, which is under professional and other considerations, regulatory environment. By now, we have weighing for corporate governance. So corporate governance now is now 10 marks in the new syllabus. So be expecting questions for corporate governance for 10 marks. This will be your question 5A. Your question 5A, corporate governance will be for 10 marks. So be expecting that. Now, the other changes I've noticed so far is on audit reporting. On audit reporting, previously, under the old syllabus, you may not be required to draft an appropriate section of the audit report. Take note. Under the old syllabus, you may not be required to draft an appropriate section of the audit report. But the new syllabus, you can be asked, they can ask you to draft an appropriate section of the audit report. So you have to take note of that. They can ask you to draft. So what it comes under audit opinion, what goes in there? How is that paragraph framed? So take note of the framing. Take note of my document I've shared on audit reporting, my lesson note I've shared on audit reporting, how each paragraph is supposed to be framed is there. Take note of them and know how each paragraph is supposed to be framed, because you can be asked to to state or to draft an appropriate section of the audit report. Now, for advanced audit and assurance, we know that the weighings The questions are basically 5 questions, no doubt about that. Now, your question one is on professional and other considerations. That's the way, professional and other considerations, which will be 20 marks. Now, that 20 marks, 10 marks will be on evaluation and advising on ethical and legal issues for specified audit and assurance engagement. So you'll be asked to explain ethical requirements, to explain legal issues. What is in the chat box? Let me check that. Please, can the document be reshared again on the page? I don't know if it is the one I'm projecting currently you are asking. If this one is already on the page, somebody can just re-forward it to the page. This one is from the ICAG, the examination structure. What you are supposed to know under each of the way. So somebody can just forward it to the page or forward it here. But just send it to the chat box here for our brother to have access to.
So please, the 2 documents. It seems like some of us are not on the page that you've shared.
Okay, so somebody can just forward the 2 of them to the chat box here. Just send it to the chat box for them to have access to. All right. I believe that will be done. That will be done. The intervention questions. Okay, it will be sent here. All right. So for professional and other considerations, basically there are 4 topics there. For professional and other considerations, there are 4 topics you have to know. The first one is what we call professional responsibility and liability. So auditor's responsibility and auditor's liability. Then the second topic is regulatory environment. So around in the auditing space, what are the required framework that regulates the auditing practices? So we use the international standards on auditing. So under that, there are certain things you have to know. By now, I believe we are all aware of the things you are supposed to know. So that place you learn about audit expectation gap and how to close the gap So, and the third topic is practice management. So practice management is basically for what? I believe everything will be here, so it will be good. I take them one by one, then I give brief explanation about them. Give brief what you are supposed to know about them before we start tackling the questions. So the first one is evaluate and advise on ethical and legal issues for the specified audit and assurance engagement. So professional responsibility and liability. Professional responsibility and liability. We talks about the ethical requirements of the auditors. So you may be giving you questions on ethics. So the ethical standards, the fundamental code of ethics, the integrity, objectivity, professional responsibilities and liability, integrity, objectivity, professional competency and due care, confidentiality, and professional behavior. You know them. Then we have the threat to the ethical principles, the conflict of interest, all the threats, self-review, intimidation, all of them, and how to tackle ethical questions. Now, in exam, in advanced audit and assurance exam, it is not all the case they will give to you, ethical case they will give to you, that you will see that always you have to identify integrity, objectivity, the fundamental principles. No. Everything that you have identified in the case, that is unethical. Talk about it. It's an ethical issue. So you may take examination pass question. They are not talking about confidentiality. They are not talking about integrity. They are not talking about objectivities. But they are talking about other things, other ethical issues. When they give you a case and anything you have identified in the case to be an ethical issue, talk about it. You'll be good to go. So you should be able to evaluate and advise on legal, professional, and ethical issues that may arise for an engagement, including evaluation and communication with any party to the engagement. So, including what? Communication to what? To management and communications to those charged with governance. To those charged with governance. You know, under the corporate governance, that's where the audit committee comes in. So you have to know the responsibilities of the audit committee, the matters that the auditor should be able to communicate to those charged with governance for help. Those charged with governance, audit committee, they are there to serve as a link between the auditors and management. So if you, the auditor, you have communicated your appropriate findings to management, but management refused to do the necessary corrections, the next person in line is those charged with governance, audit committee. So you communicate to them. They'll also come and communicate to management for the necessary corrections to be done. If management still refuse to do the corrections, you know the next step where you go to. Then you consider the impact of that on your audit report. The next step is the audit report. Now, the next thing is discuss procedures for obtaining professional work, including tendering, advertising, and agreement of fees. This is under, what topic is this? Professional work, how auditors secure the auditing work. Normally, they use the method called tendering. So you have to know the tendering requirements. This is under a particular topic. What's the topic? So audit, who is that? Audit engagement and how, Auntie Jennifer, you're welcome. So you should be able to know how auditors secure an appointment as an auditor. Normally, auditors, they're allowed to do an advert. You can do an advert, but there are certain conditions. Those conditions will not permit you to do an advert. If you want to do an advert, the advert should not be discriminatory. You shouldn't do an advert that would discredit your profession. The advert, you shouldn't what? Do exaggeration of fees. In what? In the advert. You shouldn't do price comparison in the advert. So if you want to do adverts, you should be straightforward. You see, those conditions will prevent the auditors from doing an advert. So the best way that auditors secure an appointment is through what we call the tendering process. So the audit firm, the client will require the audit firm to tender in their documents. So their proposals, they should tender in their proposal. Their proposals will be reviewed. They will be reviewed. If certified management would like you to come and give them a presentation on the tendering, if management is satisfied with your proposal, then they will appoint you and give you what? The appointment as the external auditors of the firm. So kindly do your revision on that, the tendering process. Now, the audit fees. There are so many forms of audit fees. We have the initial audit fee, which is normally calculated based on the number of auditors and the number of days they work by the specific rate. So the rate for a qualified professional auditor will be different from someone who is partly qualified. Then there are certain things that will be considered in determining the audit fees. The location of the audit firm to the client, the procedures proximity to the client with the intended purpose of the audit report. What's the audit report to be used for? Those things will be considered before you set your audit fee. They're what you call low balling. Another audit fee, what you call low balling. The auditor setting initially a low fee for the audit with the intention that when they secure the contract, in the future time, they can be able to recoup or to recover their loss for setting the low fee. But if you want to set a low balling fee as an audit firm, you must make sure that it does not have any impending factor on your objectivity. It will not affect the quality of the audit you perform. So you can allow to set a low fee, low balling with the intention that, okay, you recover the fees, the lost fees in the future. If you want to do that, the standard, you must make sure that the quality of your audit is not affected. There are other audit fees that can be set, can be set. The other audit fees, unpaid audit fee. If the audit fee is there, your client is not paying. Normally, so it will become a loan that the auditors have to give to a client. It will become a loan. You have what we call a referral fee. When you refer somebody, when you refer an audit firm to your client, you get a fee, what we call referral fee. Now, when you are going to set the audit fees, I said earlier that there are certain things you have to consider. So first of all, you consider, I mentioned one, the proximity of the audit firm to the client place. Another important thing you consider is expertise. So if you need an expertise other than an accounting expertise, you must make sure that you factor that the service fee for that expertise in your audit fee. For example, if you are going to conduct an audit, then you need a service of a professional valuer. You need somebody to value the assets of the entity for you to know that the entity has actually valued the asset based on the professional standards. And you, the audit firm, you don't have that expertise. That's someone who can value that. You don't have that professional valuer in the firm. You have to make sure you are going to sort for the service of that professional valuer. So you have to factor that in the audit fees. All right. So the next thing is recognize and evaluate ethical dilemmas and threats in accepting an engagement. So before you accept an engagement, there are certain things that the new clients you have to take. You have the new audit firm you have to consider. There are certain things you have to consider. So first of all, there are methods of investigation that you have to carry out before you accept the engagement. So first, you talk with the existing audit firm. Get their audit working papers. Review their audit working papers. Find out from them, why is it that they have resigned from the audit or they were sacked by the client? What is the main reason? They will tell you. So get the necessary information from the existing auditors before you know whether you accept the engagement or not. So you may get a question on auditors' acceptance of an engagement. So they'll ask you, what are the issues that the new audit firm should consider before accepting the engagement? So you talk about the ethical requirement, the ethical dilemmas that the audit firm have to consider before they accept an engagement. Then matters to be more senior colleague engagement and make judgment when it may be appropriate to refer an ethical matter to a more senior colleague or for a third party for advice or consultation. Evaluate the extent of legal liability, professional responsibility and liability in both criminal and civil law, including professional negligence issues and how they can be mitigated. So now we have auditors' responsibilities and liabilities. We know responsibilities of management. The management, they are supposed to institute internal controls and make sure that the internal controls are functioning effectively. Management, it is their responsibility to prepare the financials, to prepare the financial statement. Their responsibility to make sure that the financial statement is prepared in accordance with applicable financial reporting framework. Auditors' responsibility is to perform procedures, obtain sufficient and appropriate audit evidence, the other to express an opinion on the true and fairness of the financial statement. Now, if that responsibility is not carried out well, then auditors will feel what we call a liability. So liabilities due to professional negligence. Now, if the audit is not performed in accordance with applicable financial reporting framework or in accordance with international standards on auditing, international standards on auditing, the auditors can suffer criminal liability and civil liability. The criminal liability is that it is normally between the auditors and the client. You see, the auditors and the client, they have a contract. They have what we call law of contract. Because that contract existed between the audit firm, the auditors, and your client. They're giving you the contract for you to provide audit service for them. So you, the auditor, if you don't know, you perform that audit negligently, or the audit was performed without considering the audit risk. the risk that the auditor may issue an inappropriate opinion on the financial statement without considering the possible risk. You don't have any proper quality control procedures in place, and the audit was not conducted appropriately, your clients can sue you. That's what we call criminal liability. And there are certain ways that auditors can involve in criminal liability, helping your client to prepare for statements. There are certain ways that auditors can be involved in that. Then the civil liability is normally between the auditors and the third party. It could be the customers, the investors, the bank, and the rest. This one, the third parties does not have a contract between the auditors and that third party. They don't have. So they will act based on the audit report you have provided. You provide the audit report that the entity will be able to continue for a foreseeable period of time based on the going concern assumptions. That's the reason why it is very necessary for auditors, before you issue your opinion on the true and fairness of the financial statement, you consider what we call going concern. So under the review, under completion and review, you do what you call going concern. It is very, very important. If you don't do appropriate review on going concern and you issue inappropriate opinion on the financial statement, then in your report, you issue an qualified audit opinion. Then within a year or two, that business collapse. Investors rely on your audit report to invest in the company. Banks rely on your audit report to give loan to that company. The bank and the investors can sue you. That means you perform the audit negligently and you can be sued. And there are ways to mitigate it. And even under the criminal law, which is the civil law, under the civil law, which is law under the law of tort, there are certain factors that the third party must be able to prove before they can be able to win the case against the auditor. There are certain factors they must be able to prove. I believe you are on top of those factors. So first of all, they should be able to establish that contract, that law of tort exists between the auditor and the third party. Then they should be able to prove that actually they have suffered a financial loss. So existence of the law of tort, actually they've acted based on the auditor's report and they suffer a financial loss. They should be able to prove them before they can be able to win the case. And they should be able to prove that the audit was conducted negligently. And for the auditor's liability, there are ways that you can mitigate against it. So you can decide to meet the liability, avoid the liability. Or the third one, you meet the liability, you avoid, and the third one is what? You limit. You limit the liability. So you limit the liability. You avoid the liability. You avoid the liability by what? By making sure that you have appropriate quality control procedures in place. You make sure that during the assignment of audit work to the auditors, the assignment was done based on the expertise. You've considered all the necessary factors before you assign each individual auditors for an audit assignment. Proper review was done. So quality control can be done at the audit firm level and the engagement level. So before you even accept the engagement, you must make sure you do all the due diligence process. You have done all the quality control procedures. You make sure you perform. Yes, Senior. Yeah, Senior, I can hear you.
I was saying before I wasn't hearing you. That's why I can hear you now.
Okay, all right. Thank you very much. So quality control, we know that it is done at two levels. At the audit firm level and at the engagement level. So at the audit firm level, the auditors must make sure you have the quality control procedures in place. You conduct adequate training for what? You conduct adequate training for your employees. The recruitment process is in line with the best code of practice, the company's code. And you update the knowledge of your staff on regular basis. At the firm level, when the audit, you have accepted the engagement, you are not performing the audit. You make sure that the audit is done based on the international auditing standards. Proper review is done. And you know how review can be done. Review can be done, you can do the peer review, You can do continuous review, you can do periodic review, you can do hot review, and you can do cold review. All right. Now, who is this? All right, that side will give you 10 marks. Now, the engagement plan level is also for 10 marks. So you are to evaluate the potential issues that determine the nature, scope, and extent of an engagement, paying attention to the following. So personnel resourcing, quality management requirements, the use of internal audit components, auditors and experts. There are certain instances whereby the external auditors can rely on the work of the internal auditors. So you have to know that when the internal auditors, they have the necessary expertise to conduct the work, the scope of their work. If the scope of their work is in line with that of the external auditors can rely on their work. If the internal audit staff is given the needed resources to perform the audit, then the monitoring procedures used by firm to ensure effective management of engagement, the requirement of joint audits, including engagement involving auditors from both private and public sector. Evaluate the consideration for an auditor of business risk issues identified prior to accepting an engagement, including those arising from technological advances, cyber security, and fraud, and assess their impact. So the business risk, the risk that the organization will not be able to achieve its intended objective. Those identified before accepting the engagement, how will you manage them? Now the business risk identified after accepting the engagement, how will you manage them? You know, under the auditing proper, which is the audit of historical financial statements, the first thing you do is to do planning. And under planning, you do what you call risk assessment. So while you're assessing risk, we will discuss that, the type of risk. So business risk, financial statement risk, and audit risk. How will you manage the risk that you have identified before the acceptance of the engagement? Now evaluate how engagement terms can be agreed and recorded by an auditor, including those agreed with a client and those imposed by laws and regulations. So before you accept an engagement, what are the procedures you have to perform? Then exercise professional skepticism and judgment in obtaining information, preparing an engagement plan. This will give you your 10 marks. So this one is on professional and other considerations for 20 marks. So there are 4 topics: professional responsibility and liability, regulatory environment, practice management, engagement acceptance, and engagement process. Now, question 2. Your question 2 and question 3 will be on audit of historical financial statement. So the probability of you passing the exam depends largely on your understanding of the issues and the audit of historical financial statement. Because your question 2 and your question 3, which will give you 40 marks, is under audit of historical financial statement. Now, under audit of historical financial statement, there are 3 things that we do. So first, you do planning. After you plan, you execute. You do execution. Then the last one is completion and reporting. Completion and reporting. Now, these 3 things, this is where the 40 marks will come from. So I'm saying that you passing the exam depends largely on audit of historical financial statement. Now, the first 20 marks, that's question 2. The question 2 is on application of audit and assurance methods for a specified engagement to gather evidence. So it's on the audit strategies. This is done under planning. Mind you, under planning, there are certain things you do. Under planning, the first thing you do under planning is you obtain knowledge. You obtain knowledge. So you have to know about your client. The person you have accept the engagement to audit, to be their auditors. First of all, before you start auditing them, you must know about them, know about their work, know about their environment, know about their operational activities. So you obtain knowledge, and there are ways that you can use to obtain knowledge. You do interview of management, interview the employees, media reportage about the company, go to the company's website and read about the company and the rest. Know about them. After you know about them, then you do what you call risk assessment. It's very, very important because now the current auditing trend is risk-based. It's risk-based. So you do risk assessment. And under the risk assessment, we learned about 3 types of risk. So you have business risk. We have financial statement risk or material misstatement risk. Then we have audit risk. The business risk is anything, any risk. It could be positive or negative. That will prevent the organization from achieving its intended objectives. So there are certain things that you have to know. That will be the business risk, that if they give you a question, you should be able to remind them. So the business risk that you'll be required to, we have the micro one, and we have internal business risk, we have external business risk. It could be macroeconomic conditions, microeconomic conditions, inflationary rates, depreciation of the currency, technological factors, and those ones. Those ones are normal. But in terms of exam, when they ask you to do business risk, the things you have to write, when they ask you to do a business risk, the things you have to write is what? Operational risk. So in the case, if you identify anything that will have effect on the operational activities of the organization, that is a risk. For example, the business is having operating license, and there are certain requirements. Knowing about them, maybe there are environmental regulations that they have to follow. And now we have a requirement of environmental audit. Now I realize that the business is violating the requirements of the environmental regulations. They are polluting the environment. It is very likely their license will be revoked. If their license is revoked by EPA, that means that the going concern status of the business will be affected, and their operational activities will also be affected. Then you can write, I don't have all of them in my head, so if you guys can help me, I gave that one during the normal class, the things you are supposed to write. So you have operational risk, reputational risk. Which one again? Control risk.
Control risk.
Okay. That means the internal controls are not working. The internal controls are weak. The control risk, I gave you an abbreviation in exam. Anytime they ask you to do control, to recommend controls, I gave you an abbreviation to use. That abbreviation, don't forget it. I gave you that. Anytime they ask you to recommend controls, so soap spam, remember them. Use it to apply it, relate it to the case, and you'll be good to go. Segregation of duty, organizational control, arithmetical accuracy, personnel training, supervision. The P is what? Physical control, authorization, and management control. Anytime they ask you to recommend control, remember the abbreviation. Use any of them. Tell them that there should be segregation of duty. The person who will perform this task should not be the same person who will review the task because of self-review trait. Somebody should do this one, the task should end here. Another person should also continue. That segregation should be there. There should be authorization. Somebody should authorize the use of funds before they will make any payment. Somebody should authorize that there should be personnel training. personnel should have adequate training. There should be what? Supervision. There should be adequate supervision. Now, if the controls are weak, mind you, is the outcome of the risk assessment that will determine the audit methods that you have to use. So if your risk assessment tell you that, oh, there are lots of control weaknesses, that will have impact on the audit methods that you are going to use. If the risks are more or less like financial statement risk, the risk show that there will be a lot of misstatements in the financial statement. Mind you, if the controls, yes, Senior. I can hear you, Senior. All right, let's continue. If he's back, he will ask the question. Mind you, if there is a link between...
Sir.
Yes, I can hear you, sir. Senior Samuel, I can hear you.
I was saying that the forming of source span.
Yes, we just gave that to somebody. Should drop it in the chat box.
Right, thank you.
Somebody should just drop it in the chat box. Right? Okay. So mind you, there is a link between the business risk and the financial statement risk. The higher the business risk, the higher the financial statement risk. If the controls are not working, there's a likelihood that there will be a lot of misstatements in the financial statement, which will result in the financial statement risk. Which one again? Reputational risk. We have financial risk. No, is it financial risk?
Yes.
That poor financial management, is it financial risk?
Yeah, financial risk.
Yeah, there's no proper finance management of the company. I think we have more. I think we have 2 or 3.
The system is not strategic risk.
Have a guess here.
Strategic risk.
Yeah, there's no long-term objective. There's no strategic goals of the organization. All right. So if a lot of the risk you identify are business risk, especially the controls are not working. You see, auditing normally based on the internal controls. We want to see what are the controls that the organization have in place that will mitigate against the risk. So the test of the controls. If the controls are weak, which method will you use to conduct the audit?
Test of control.
Test of control. That is system-based approach. Is that not it? System-based approach. So you are going to do test of control. Test of control. So you are going to use system-based approach. So you test the internal controls and see if the internal controls, how are they working? How are the internal controls functioning? Now, after the business risk, we have the financial statement risk. And the financial statement risk, I believe you know what to write. So under the financial statement risk, there could be what? Over or understatement of assets. There's a risk. Mind you, this one, you have not started conducting the audit. You are not sure. If you are done with the audit, you can say categorically that, oh, the asset was overstated, asset was understated. You are doing this under the planning stage. You have not started with the audit yet. So for the material misstatement risk, if they ask you, there could be over or under statement of assets. To me, that assets will not be recognized very well. Asset recognition, you use PPE. The PPE standard, that is IAS 16. IAS 16 will not be followed. So in that case, assets may be over or assets may be understated. Then you have over or understatement of revenue. That means that revenue will not be recognized in accordance with the requirements of IFRS 15, revenue from contract with customers. So there'll be a risk there. Then you may have over or understatement of liabilities. There's a possibility that the liabilities may be over or liabilities may be understated. Then the fourth one is over or understatement of expenses. So there's a risk that the business may what? May understate its expenditures, or they may overstate its expenditures. Then the fifth one is, what the fifth one?
Non-disclosure.
Non-disclosure. That the disclosures, there's a risk that the disclosure standards may not be met. So you have to know all the disclosure standards. IAS 37, provisions, contingent liabilities, and contingent assets. We have IAS 24, related party disclosures. IAS 8, accounting estimates, change in accounting policy and error. What other required disclosure standard do you have? All the disclosure standards, all of them. There will be a risk that all of them will not be what? The requirement of those standards will not be, especially IAS 24, related party transactions. All right. Now, the audit risk. In a question, they can ask you to do audit risk. They can ask you to do audit risk. And the audit risk, in simple terms, is that any risk that will make or that will prevent the auditor from issuing appropriate opinion on the financial statement. So anything that will lead the auditor to what? To issue inappropriate opinion on the financial statement. That's an audit risk. So anything that you have identified in the case, that will maybe this way to make the auditor not to issue appropriate opinion. Because if the auditor did not dictate that, that's the reason under the audit risk, we have the control risk, we have the detection risk, and the third one is what?
Inherent risk.
Inherent risk. So if they ask you to do audit risk, anything that you have identified in the case that will prevent the auditor from, if the auditor did not dictate that, or if the treatment of that item is not done in line with the applicable standards, it will make the auditor to issue inappropriate opinion on the financial statement. That is audit risk. Now, for the first 20 marks, it's about the methods. So how you apply the auditing methods on a particular engagement, how you apply the auditing methods to gather evidence, how you apply the methods. Then we talk about the system-based approach. Then we have the substantive testing approach. Substantive testing. This one is test of details. So basically, you are doing management assertions. I said earlier that it is management responsibility to prepare the financials in accordance with applicable financial reporting framework. And before you start every audit, management will give you what we call written representation. Written representation. So this one is a document, letter written by management to the auditors, confirming that they have prepared the financial statement based on the applicable financial reporting framework. So management will give you an assurance that, everything in the financial shows the true and fair position of the entity. So that is ISA 580, yes. The requirements of International Standards on Auditing 580, written representation. Now, when you obtain this representation, it's an assurance management has given to you that, the financial statement, we have prepared it. There are no errors in the financial statement. Now, when you are doing substantive testing, you are just testing the items in the financial statement. You are just testing the management, the items on the face of the financials. So you do account balance. Account balances is done for statement of financial position items. So while you are checking management assertions for account balance, this one is done for statement of financial position items. So there are certain things you check. What are the things we check under account balance? What are you checking?
So accuracy.
So you check accuracy.
Cut-offs.
You check cut-off. We know the meaning of cutoff. You make sure that the transactions on the face of financials, they are within the financial year. No transaction that will fall within outside the financial year should be within that year. So you check cutoff, you check completeness.
You also check occurrence, whether they actually occurred.
Okay, so you check completeness. You check occurrence.
Classification.
You check right and obligation. The right and you check valuation. You see, for the account balance item, right and obligation and valuation is very, very important. Because account balance item, statement of financial position, that's why you have your assets and your liabilities. How was the asset valued? How was the asset valued before putting on the face of the financials? Right and obligation. Does the entity have the right to disclose their liabilities on the face of the financials? Is the entity obliged to do what? To recognize a liability or to recognize a provision? You check accuracy, you check completeness, you check cutoff. Then, if you come to transactions and events. Transactions and events, what are you checking?
Occurrence.
Okay. Either if the revenue, the expenditures have actually occurred for the period.
Sense.
You check classification, that's very good. You check classification. How was the items classified? You check cutoff and the rest. Thank God we know what you are checking over there. Check accuracy and the rest. All right. Now, in exam, take note. If they ask you to do principal audit risk, the question say discuss 4 principal audit risk that is facing the company. My brothers and sisters, anything you have identified in the case to be a risk, talk about it. So if they ask you to do principal audit risk, if the question is specific, that is fine. If the question asks you to do audit risk, that is fine. Audit risk is not a business risk. So don't worry, I'll be talking about business risk. Or they ask you to do audit risk. If they ask you to do financial statement risk, material misstatement risk, these are the things you are going over, and the statement of assets and the rest. Those are the things you are supposed to be talking about. If the question has to do only business risk, no, you are going to be talking about operational issue, financial issue, strategic issue, reputational issues, and the rest. But if the question says do principal audit risk, mind you, you are going to combine all of them. So it could be business risk, it could be audit risk, it could be financial statement risk, it could be what? You do what you call analytical review. Analytical review is very, very important. So specifically, when in the question they are giving you figures, they are giving you figures, comparative figures from the previous financial year to the current financial year, and they're asking you to do risk. Do analytical review. Check the figures. So you can use ratio. You can do line by line comparison. You can do horizontal. You can do vertical. So you can check the difference between the figures. Is the figure increasing? If the figure is increasing, if the revenue is increasing, what is the cost? That's the analytical review. So you are going to do what? Computations. So analytical review is computation, calculations. So you can equally calculate materiality depending on what the question the examiner gives you in the question. So if they ask you to do principal audit risk, anything that you have identified to be a risk in the case, talk about it. So for the 20 marks, risk assessment taking into account inherent risk, control risk, and detection risk. Materiality discussion. Materiality discussion. You know the materiality. Anything that will affect the decision of the users on the fund. If that thing is omitted from the financial statement, it will affect the reliance that users will place on the financial statement. If that item as a single item or the aggregate of that item with a similar items. So you have to know the threshold. So you have to know the threshold. So from you have to know the threshold for materiality. And materiality is relative. It's relative. Normally, it is set by the audit firm, and it normally depends on the size of the company you are going to audit. Because what is material in one company may be immaterial to another company. Somebody who is selling cocoa at the roadside, if you take 100 cedi from that person's money, it will affect that person's business. But go to the big companies, take 100 cedis out, nobody will even know. You will not even have any effect on them. So materiality depends on the size of the entity and the operational activities of the organization. So this one is normally set by the audit firm based on their professional judgment, internal control assessment, including IT controls. So if the company is using computer-based information system, companies is using software, what are the controls in place? So you know the controls relating computer-based information system, automated auditing techniques, computer-based information system. There should be a general control and there should be specific control. The general control talk about the designing of the software. Who designed the software? Who authorized the designing of the software? Who supervised the what? The designing of the software? Who tests the software? Those controls must be in place. Those controls might be in place. Then if you come to the specific controls, you talk about the usage of the computer-based information system. You are using software to record your inventory. You are using software to record your receivables. What are the controls you have in place? You must make sure that there are enough antivirus to prevent viruses from attacking the system. Somebody should authorize the input that will be making the system. Somebody should supervise the input, all those things. And reliance on internal audit work, experts, and the work of other auditors. Use of client-generated data information report, tests of control, substantive procedure, including analytical procedures, visit to locations, branches, and departments, discuss appropriate procedure for audit and insurance engagement for corporate social responsibility and sustainability report. Now it is the requirement of every organization to include in their financial statement a section on sustainability report because of the sustainable goal development goals. Now, which standard is that? Which standard talks about the sustainability reporting? Is it IAS 18 or IFRS 18? You should do it in corporate reporting.
IFRS 18.
IFRS 18, sustainability reporting. Now, so the need for the organizations to include that in their auditing report. So the auditors will have to review that based on the IFRS 18. So basically for question 2, it will be based on the planning of the audit. Planning of the audit. Question 3 is evaluation of a specified engagement, audit and assurance evidence, and conclusion and reporting on the engagement. So question 3 is on execution, completion, and reporting. Very, very important. Now, the execution there is very simple. Evaluate and propose how issues identified during an assignment may be raised and dealt with in communication with management, directors, and those charged with governance, including action taken when issue cannot be what? When issues cannot be agreed. So under the execution, you perform procedures. You perform procedures to obtain sufficient and appropriate audit evidence. So the audit evidence you have gathered should be sufficient enough for you to use that. Based on that you form an opinion on the financial statement. The audit evidence should be enough. The quantity of the audit evidence. What volume of audit evidence will you get for you, the auditor, to satisfy yourself that, oh, you have enough audit evidence in order to form a conclusion on the financial statement? So we talk about appropriateness and sufficiency of audit evidence. And we talk about reliability of audit evidence. Reliability of audit evidence, we say in all cases, the auditor-generated evidence is the most reliable one. We don't rely on photocopies, oral representation. If you can convert it to a hard copy, then fine. We will take that. We don't want photocopy. Give us original document. Evidence from within. When internal controls are strong, it's better than evidence you are getting when the internal controls are weak. And evidence that you have generated from external party, knowledgeable people. Those evidence, you can rely on them more than the one management themselves will tell you. Because if there is an issue of fraud, misbursement, investment of funds, management, they will try to prevent that fraud from you. They'll try to prevent it. So if you ask them any question, they will not tell you the truth. They want to see if you, the auditor, can be able to detect that. So you cannot rely to a larger extent on what management will be telling you. And during the engagement process, during the execution process, all misstatements you have identified, you know that you have to communicate the misstatement to management, directors of the company, and to audit committee. And if management refuse to make the necessary corrections, you know what will happen? You consider the impact of that on your audit report. Consider the impact of that on your audit report. Apply procedures that may be used and consideration relating to the identification of subsequent events that may require adjustment or disclosure. So this is under review. Under review. You know, after you have done your audit, you have obtained sufficient audit evidence. You are now sure that, okay, you have obtained enough and appropriate audit evidence. You do what we call review. And under review, one thing is what we call subsequent events, which examiners like most. Subsequent events. It means that before the audit report will be signed finally, before the auditor, you sign the audit report, you must make sure that you take note of all events that occurs after the reporting period or that occurs before the reporting period. So the subsequent event, that is 560. That is 560. So international standards on auditing 560 and international accounting standard 10. IAS 10, that is event after reporting period. And IAS is 560. That talks about subsequent events. You must make sure that you review the requirements of IAS 10 because there may be those events, some may be adjusting and some may not be adjusting. Some will only require disclosures to be made in the financial statement. And you have to know them. The standard clearly distinguishes between the two. Adjusting events are those events that have a condition that existed before the end of the reporting period. And non-adjusting, there was no condition that was existing before the end of the adjusting period. So you have to know the treatment. So adjusting events, go and adjust the financial statement. Non-adjusting events, make a disclosure in the financial statement. If management refuses to adjust the financial statement, you consider the impact of that on your audit report. If they agree to adjust the financial statement, fine. It means that the correcting has been done. There's no issue. If the event is a non-adjusting event and it requires a disclosure to be made, and management refuses to make the disclosure note in the financial statement, you consider the impact of that on the financial on your audit report. If they have done the disclosure, that is fine. There's nothing you have to do. So go through the standard IAS 10, events after reporting period, adjusting events and non-adjusting events. Normally, it's examiners like these court cases. The business is having a court issue before the financial year end. Just that the final determination was not made by the court before the financial year end. Now, during the period of the audit, after the financial year ends, during the period of the audit, before the auditor, you sign the audit report, before you complete your audit and issue your audit report, the court has now made a final determination. So that is an adjusting event because the court case was existing before the year end. So management go back and make the adjustment in the financial statement. If they agree to do that, that is fine. If they say they won't do it, consider the impact of that on your audit report. Now, that the standard says that it's 560. So before the period, before the auditor, you will sign the audit report. Normally, the financial year will end. The financial year will end. Then you, the auditor, you come and conduct the audit. So The ISA 560 is requiring each auditor to take note of those subsequent events before the auditor signed their audit report. So from the date of the auditing to the date that the audit report will be signed, we say that the auditor have active stand. So the auditor, you have to actively look for significant subsequent events. You have to actively look for significant subsequent events. Then after you have signed the audit report, you have signed the report already. So what you do is you have a passive stand. So at that time, you don't have a duty. You don't have any obligation to actively look for any subsequent event. But if any subsequent event attention has been drawn to you, the auditor, then you consider the impact of that on your audit report. Then you go back to your audit report and say that, okay, if like this event, my attention has been drawn to it before I sign the audit report, what implication will it have on my audit report? So you go back and perform procedures. Go back, have discussion with management. What is management requirement? Okay, management say they will adjust the financial statement. Good. If they will adjust the financial statement, then what you do is you go back, take the old audit report, tell management they should bring the old audit report. You have to write another audit report now and give that one a new date. But in case management say they will not adjust the financial statement, then the other procedures, the additional procedures you can perform as an auditor is to go to the annual general meeting, which is your right. Go there and speak to the shareholders that this event has occurred, but my attention was drawn to it after I have signed the audit report. But management say they will not do the necessary adjustment in the financial statement. It's better you go talk to the shareholders and other stakeholders. Now, the next thing is apply procedures that may be used and considerations relating to the identification of risk issue that may require disclosure, evaluate quantitative and qualitative judgment based on the results of tests and evidence, advise on the capability to report on an assurance engagement or audit engagement, including reporting findings, giving an external audit opinion, or dealing with other issues that may require to be included in the audit report. Now, the review stage, completion and review. There are so many things over there. I only talk about, I don't know if let me talk about all of them before we move on. One of the review is the subsequent event, which I just spoke about it briefly. There you equally do one review on evaluation of the statement. So at the completion stage, that's the time that you, the auditor, all the misstatements that you have identified in the audit, gather on the misstatement. Check the materiality level of all the misstatements. Check and see if the misstatement, whether individual or aggregate of the misstatement, what impact would they have on the decisions that users can place on the financial statement. So that's the time you gather all the misstatements, you communicate the misstatement to management to do the corrections. You communicate the management to do all the corrections. If management refuses to do the corrections, the next person in line is the audit committee. Communicate to those charged with governance. They will also come in. If they also come in, but management still refuse to do the corrections, then you consider the impact of all the misstatements on your audit report. What opinion will you make it to issue? So we go to the audit reporting and how the reporting is drafted. The requirements for the modification of the auditor's opinion. We're talking about it. Then, yes, I think it's equally here. Draft extract of a suitable audit report or management report based on a given scenario and entity and in accordance with local law and international standards on accounting and auditing. So I said it earlier that you can be asked to draft an appropriate section of the audit report based on the scenario given to you in the case. So go back, take your notes, read through how each paragraph of the audit report is drafted, how it is written, because you can be asked. And when you are asked, you must make sure you bring in the necessary terms how it is drafted, you must make sure you bring in the necessary terms. It's very, very important. Then apply suitable judgment on when it may be appropriate to refer to an expert in forming an opinion and preparing audit report. Apply suitable judgment on when it may be appropriate to withdraw from or withdraw an opinion or take other such appropriate actions or on an audit or assurance engagement. Now, the review, I spoke about two. So the third review you do is going concern. Very, very important. Going concern. So you review all going concern issues, all issues that may cast a significant doubt on the going concern assumptions of the entity. So the going concern is a 570, yes. So it's a 570 talk about going concern. The requirement of is a 570 talk about going concern. So you review all issues that may cast a significant doubt on the going concern assumption of the entity. So the issues could be operational issues, it could be financial issues, or it could be other issues. So all those issues, review them, operational issues. The entity is not able to maintain key customers. But there's emergence of a new competitor. That competitor is coming in with a new product, which will throw your company out of business. That's operational issue. Financial issue. The company is facing a liquidity challenge. They don't have enough liquid resources to settle their obligations as and when they fall due. Loss of key customers. Loss of key financial customers. Customers are not willing to operate with your company again. All those things will cast a significant doubt on whether the entity will continue to operate into foreseeable future or not. Other ones, it could be employees are leaving the organization, the managers are leaving the organization, there's a riot, labor riots, inability to pay wages and salaries to your workers. What shows that you'll be able to be in operations? So you review all those things. Machine downtime. Your machine is not working and you cannot even repair the machine. You don't have enough resources to maintain the machine. Your going concern status is questionable. It's in quote. Who is that watching science and math quiz? Who is that?
That's the preamble. All right. So,
Solomon.
Sorry, I'm trying to mute the person, but the person will mute. Solomon Kosa, can you mute your mic, please? All right.
Yes.
Mr. Solomon Kosa, can you mute your mic, please? All right. Let's move on. All right. So you consider all going concern issues and the requirement of the standard is the impact of the going concern issues on the audit report. So you know how the going concern issues are treated in the audit report. Now you have to bring in a new paragraph. It's a 570 revised. The revised version of it's a 570. Now, if there is a going concern issues, appropriate disclosures must be made in the financial statement. Appropriate disclosures must be made in the financial statement. And if it is done, then you, the auditor, you bring in a paragraph in the audit report immediately after basis for opinion paragraph. That paragraph will be headed material uncertainty relating to going concern. So you draw users' attention to those issues that are in the audit, that are in the financials, that talks about the going concern. But those issues does not mean that your opinion is modified because appropriate disclosure has already been made in the financial statement. You only modify your opinion if appropriate disclosures are not made on the going concern issues you have identified in the financial statement. But if they are done, what you do is you bring in a paragraph in your audit report immediately after the basis for opinion paragraph, telling the users that, referring the users to the note that talks about the going concern issue. That at the end you say that what? It does not mean that your opinion is modified. So you do the going concern. What other review do you do again? You do opening balances and closing balances, prior year adjustment. Every auditor do that before you perform every audit. Every financial, the first thing you do is you check that all opening balances are brought forward appropriately. So that one is a normal thing that you do. It's a normal thing that you do. All right. Now let's go to the audit reporting. How is the audit reporting right? How do you write the audit report? Now you have to know the format of the audit report, because I said earlier that you may be asked to draft an appropriate section of the audit report. Now, know that audit report is written to the shareholders. The report is always to the shareholders. It's the shareholder that the report is addressed to. The report is always addressed to the shareholders. So after that, then you bring the other ones. But the most important thing is from the opinion section of the audit report. The opinion section of the audit report. So what type of opinion are you issuing? But we know that the audit report could be what? Could be modified, or it could be unmodified. And if the audit report is modified, it means that there are some form of misstatement in the financial statement, which means that the financial statement is not true and fair. So there are other form of modification that can be done. So it could be modified, except for, it could be disclaimer. No, it could be adverse. It could be adverse opinion. It could be disclaimer of opinion. If it is unmodified or unqualified, now I show that the financial statement is true and fair. There are no misstatements in the financial statement. There are no misstatements. But if there are misstatements, on that basis, you modify your opinion. It means you qualify your opinion. Now, basis for the modification. What will make you to modify your opinion? So the modification can be take any of the three of this opinion. So if you're issuing qualified or modified except for, it means that the issue is material, but it's not pervasive. And we know about the pervasiveness. How widely is the item spread in the financial statement? So it's material, yes, it's material, but it is not widely spread. It does not cut across all the items in the financial. So it will be modified except for. So except for this item, the financial statement shows a true and fair view. The adverse opinion, the issue is material and is pervasive. They issue adverse opinion. Disclaimer of opinion, it means that due to the limitation or scope placed on auditors by management, the auditor, you are not able to perform your procedures in order to issue an appropriate opinion on the financial statement. So the disclaimer of opinion, due to limitations placed on auditors, the auditor, you are not able to obtain sufficient and appropriate opinion in other appropriate evidence in order to issue an opinion on the financial statement. So you say nothing. So you write audit report, but the opinion will be disclaimer of opinion. Then when you come under basis for opinion, you say that there was a limitation placed on scope on you by management. You ask for this information, they say they will not allow you. You ask for this information, they say due to their privacy policy, they will not give you access to their receivables ledger. In that case, you cannot express any opinion on the financial statement. So you say nothing. Modified except for can also be based on limitation on scope. But this one is material, but it's not pervasive. It's material, but not pervasive. You want only inventory ledger, the inventory records. They are not able to give you only inventory records, but they gave you other records. You have access to other records. You have performed audits on other records. Maybe the only thing is you were not there to observe the year-end inventory count. The year-end inventory count. You are not there to observe it. Maybe you were not the previous auditors. You are a new auditor that they have appointed. You are not there to observe the previous year's end inventory count. The other way, you cannot satisfy the value of the inventory. So due to that limitation, you cannot say what the inventory figure is. You are not even able to use other procedures to confirm the inventory amount. You are not able to even certify that the inventory is valued according to IAS 2. You are not able to certify that only inventory. So you modify your opinion. You say except for. Any question? Or I can proceed. Can I move on? All right. I believe I can move on. Now, after the opinion, followed by basis for opinion. Basis for, know how the heading is captured. It's not basis of opinion. It's basis for opinion. So the opinions you have issued, it could be modified except for adverse, disclaimer, or unqualified or unmodified opinion. What is the basis? What is the basis? So you state that there. Then after basis for opinion paragraph, if you have any issue concerning going concern, then you bring that paragraph. Material uncertainty relating to going concern. Know how this paragraph is crafted. Know how this paragraph is drafted. So after that, then you move on to, if you have any issues on emphasis of matter. So you know the things that goes into emphasis of matter. So under the emphasis of matter paragraph, if there are other issues that are not going concern issues, that those matters were fully disclosed in the financial statement, and you the auditor, you think that, okay, it will help the users to understand your audit report, to understand the financial statement, even though those issues were already disclosed in the financial statement. Then you the auditor, you think that, okay, users will need those specific issues in order to understand the financial statement. You bring those issues under emphasis on the matter paragraph. And the standards clearly gives those items that may go into emphasis of matter paragraph. What are those items? What are the items that may go under emphasis of matter paragraph?
I think any significant catastrophic event that has happened.
Okay, all right. So significant, major catastrophic event that have happened within the year, and it has been fully disclosed in the financial statement, yes. Significant transactions that has happened within the year, and those transactions have fully been disclosed in the financial statement. Adoption of new standard, new IFRS, and the rest. Issues that requires the auditor's professional judgment. Then followed by key audit matters. I don't know, does the key audit matters come before emphasis of the matter paragraph? I'm not referring to any document, so I'm using my head. So does the key audit matters come before emphasis of the matter paragraph? Okay, it will come before. But the key audit matters are normally done for listed entities, listed public entities. So if you are auditing a listed company, so you take note of the client, the company that is the client. Take note, is it a listed entity? If the company is a listed entity, that means that those are some matters that may go under key audit matters. Those ones, they will not go under emphasis of the matter paragraph. We only use the emphasis of the matter paragraph if the client is not a listed entity. So the issues that goes into key audit matters for a listed entity, the same issues goes into emphasis of the matter paragraph if the client is not a listed entity. So under the key audit matters, areas that require the auditor's significant judgment, areas that the auditor have considered to be higher degree of risk, significant transactions, those areas that requires the auditor's professional judgment, accounting estimates and the rest, significant transactions. So if the entity is a key audit matter, if the entity is a listed entity, you bring those issues under key audit matters. So it means if you bring those issues under key audit matters, they will not come under emphasis of the matter paragraph again. Then followed by other matter paragraph. Other matter paragraph. So the other matter paragraph, those issues are not disclosed. The issues that goes into other matter paragraph, they are not disclosed in the financial statement. They are not disclosed in the financial statement. By you, the auditor, even if the issue will not be disclosed in the financial statement, you know the auditor, you have to consider those issues before you issue the opinion on the financial statement. You have to consider them. So you have already considered them in order to issue whether modified except for adverse, disclaimer, or unqualified opinion. You've considered them. But you still think that users will need it. Users will need it in order to understand the financial statement. So you bring it under or other matter paragraph. So one is possible effect of limitation of scope. They've limited your scope. The limitation is sorry for that. My call dropped. But I'm back now. All right, let's move on. So under the other matter paragraph, the issue is not disclosed. That's the distinction between other matter paragraph and emphasis of the matter paragraph or key audit matters. The issue will not be disclosed in the financial statement. By you, the auditor, you want to draw users' attention to those issues. So one is possible effect of limitation of scope. And you definitely consider those issues before you issue your opinion on you express your opinion on the financial statement. So you want users to know. So you state it under other matter paragraph. One is if a local law allowed the auditor to elaborate more on his responsibilities, and there's some other issues. So kindly take note of them. The last paragraph is what? Other information. So this other information paragraph is normally information obtained from supplementary documents. And these informations are not audited. So maybe you obtain some information from the chairman's statement. The chairman of the board is saying something. You get some information from the chairman's statement, management report, and the rest. But you want users to know that you put them under other information paragraph. Then you are done with all the report. Question 4 is your public sector auditing. Public sector auditing. So under the public sector auditing, it's in two aspects. One is public accountability. So normally you have to know. For it will come for 10 marks. Those charged with public accountability, what are their duties and their responsibility to make sure that state resources, public funds are used judiciously, are used in accordance with value for money, in accordance with value for money, the 3 E's. So you have to know them. This one by now, it should be on top of issues. The Auditor General, the Auditor General, who is the head of the Supreme Audit Institution. What is the responsibilities of the Auditor General? To ensure that what? Public funds are what? Are used judiciously. So discuss the statutory role of government external audit internationally and in Ghana, including consideration of the following. So the role of government external audit internationally, that is the Supreme Audit Institution. In Ghana, the Supreme Audit Institution is the Ghana Audit Service, headed by the Auditor General. So by now, it should be on top of issues. You should know the requirements. What does the law, the Constitution of the Republic, what does it require the Auditor General to do? You should know that by the end of June, the following year, the Auditor General have to prepare its report and submit it to Parliament for review. When the report goes to Parliament, the Public Accounts Committee, PAC, will have to do a sitting on the report to make sure that the issues in the report are being implemented. The role and constitutional status of the Auditor General. So what are the Constitution mandates the Auditor General to do? The role of the INTOSIGN, international what? INTOSIGN, what's the meaning of INTOSIGN?
International Organization.
International what? Organization of Supreme Audit Institution. Their rules. The responsibilities of Supreme Audit Institution in evaluating the outcomes and impact of government policies. The statutory basis of government external audit unit. Then you have to know the distribution of authority in a relationship and communication between Department of Controller and Accountant General. So you have to know the Controller and Accountant General. What are the duties of the Controller and Accountant General? The Internal Audit Agency, IAA. What is the duty of IAA? What is the main reason why IAA was established? The Auditor General's Department, Public Account Committee of Parliament, Finance Committee of Parliament. All these bodies are charged with public accountability, so you have to know their duties. They appraise the concept and mechanism of public accountability in Ghana, including the concept of public accountability, mechanism for ensuring public accountability, mechanism for ensuring value for money in the public sector. So value for money is normally the performance audit. The performance audit in the public sector. So the 3 E's. So the principles for the performance audit, which is based on the value for money, the economy, efficiency, and effectiveness. In auditing, we don't bring equity in auditing. So by public sector accounting and finance, you can bring equity, fair distribution of resources. But in auditing, the E's are 3. Economy, efficiency, and effectiveness. That is the word value for money analysis, which is basically the performance audit. The role who is that? Then the next one, corporate governance principles for governing what? Public sector audit. So the corporate governance code requires every public sector entities, and it is equally the requirement of the PFM Act, the Public Financial Management Act, 2016 Act 921, with its regulation 2019 LI 2378, that every covered entity should have an effective internal audit unit, and they should have an effective what? Audit committee. So what is the rules of the audit committee regarding the use of public funds? Internal auditors, what is their role in the public sector? The internal auditors are being managed by the IAA, the Internal Audit Regulation, the Internal Audit Agency. So what is their rules in ensuring public accountability? This one, we don't teach this one in class. So this one there, by now, you should be on top of issues on them. The roles of the following structures in ensuring public accountability: Controller, Accountant General, Internal Audit Agency, Auditor General, Public Account Committee, Finance Committee of Parliament, and audit committees of MDAs and MMDAs. Audit committees of what? Ministries, departments, and agencies, and metropolitan municipal district assemblies. They can just give you any of them. What is their role in ensuring public accountability? You should be able to get your 10 marks, the maximum pass mark over there. Now, the B part is you are to describe and explain and equally apply appropriate audit methods to public sector audit. So this side, for the 10 marks, we are going to talk about the methods, the auditing that we do in the public sector. So in the public sector, we do the financial audit. The financial audit similar to what we do in the private sector. We do performance audits. Then the last one is compliance audit. These ones are very, very simple. The financial audit is similar to what we do in the private sector. So you do the planning, execution, and reporting. It's the same thing that you do. In performance audit is normally on the government project. So explain and apply the principles of an audit of financial statement and report for a given scenario, the outcome of a financial audit. So what you know in the private sector is the same thing. You do the 3 stages. You plan your audit, you execute your audit. After that, you report. So the reporting to take the same format. That takes the form of opinion that should be expressed on the financial statement. The explain and apply the principles of performance audit and a report for a given scenario. So the performance audit is normally done for the government flagship programs, the government intervention program, the government policies. So you take one government policies that you want to find out, is the performance of that policy in compliance with the principles of value for money? So if they ask you to explain the principles of performance audit, it's the 3 E's. That is the principle based on which we perform performance audit. So what you take, let's say we take government planting for food and job, PFJ, planting for food and job. Then we want to render a performance, we want to conduct performance audit on it. So we are going to use the value for money analysis approach. The 3 E's to determine whether the program is achieving its intended objectives. So there are 3 audit procedures. There are 3 audit methods that we use in the performance audit. What are those methods? What are the methods used for performance audit? My network is fully today, but I don't know. Can somebody hear me? Can somebody hear me?
Yes, we can hear you.
Okay, my network is fully today. Now, I was asking, what are the methods for conducting a performance audit? We have 3 methods. I can just ask you to explain the methods for conducting performance audit. You know, the principle is the value for money analysis. The 3 E's: economy, efficiency, and effectiveness. But what are the methods that we use to conduct performance audits? There are 3 basically there are 3 methods. So for performance audits, the methods are 3. So I think I can remember 2. We have problem-oriented approach. So we use problem-oriented approach. Then we have result-oriented approach. I think the third one is system-oriented approach. So these are the three approaches to performance audit. Problem-oriented, what is the problem? What is exactly is causing the problem? Result-oriented, what is the result of that time? Then the system, the management, those charged with responsibility towards the governance of the project. What is their attitude towards the program? So these are the three approaches we use for performance audit. Now, under performance audit, the reporting, I'm just doing summary. The reporting, we don't express an opinion. No expression of an opinion. We don't do that. What we do is the reporting take a format of findings, recommendations, and conclusions. So for performance audit, we don't express an opinion. We don't say qualified except for no. It takes finding, the format of the report takes findings, recommendations, and conclusions. So for every performance audit, your recommendations should be what? Should be able to bring about how the programs can be performed for the betterment of the citizenry. Your recommendations should be able to improve upon how the project is being handled, how the program and the project is being handled. So that is also one audit risk in the performance audit. The risk that the auditor will make an inappropriate recommendation, or the risk that the auditor will not be able to come up with a recommendation that will improve upon the functioning of the program. So after that, you do what you call follow-up. So follow-up is normally done to ensure that, okay, how far with the implementations of the recommendations that is contained in the auditor's report. So you do follow-up to find out those charged with responsibility towards the management of the program or towards the management of the organization. Your recommendations you have made in your audit report, how far have they gone with the implementation of those recommendations? So there are ways you can do follow-up. You can do phone call, you can do field visit, you can ask organizations to prepare statements of implementation report to auditors. So normally follow-up is basically a duty of what? Of the PAC, the Public Account Committee. But those people cannot come down from Accra to Ghana, Accra to your organization and say, oh, are you doing the follow-up? So normally it is done by the auditors on behalf of what? On behalf of the PAC. So normally every auditors, if you conduct audits for previous year, if you are coming to do another audit, what you do first is you check and see how far has management gone with the implementations of the recommendations that you have in your audit report. So you do follow up to know how far has management gone with the implementations of the recommendations you have in your report. Your question 5, I said the first part, which is A, will be on corporate governance. So corporate governance issues. So you have to appraise and evaluate the nature and consequences of corporate governance and accountability mechanisms in controlling the operating and financial activities of different sizes, structures, and industries. Explain the role of board committees, including audit committee, the role of the audit committee, the requirements of the board, the corporate governance code, the company's code, the composition of the audit committee, the composition of the board of directors. You should be able to know that. Evaluate the relevant corporate governance codes for 10 marks. The other 10 marks is on current issues, current development. So normally is on issues, the current issues that is surrounding the auditing space. Is there what are the new developments in the auditing space? But for these 10 marks, there's something we call other assurance services, which can equally comes under the question 5B, other assurance services. So it may be due diligence engagement, it will be forensic audit, forensic investigation, it could be social and environmental auditing, sustainability auditing, performance review, and the rest. So these are the basic things to know: forensic audits, good social and environmental auditing, sustainability auditing, the risk and impact of money laundering. Money laundering is under regulatory environment, which is part of professional and other considerations. But now they're saying that if question will come on money laundering, it will be in question 5. To be in question 5. Challenges and opportunities around auditing digital assets and digital auditing. Because now everything is technological, and auditors, we are equally trying to use softwares to conduct the audits. Organizations are now, all of them are now using computer-based information system software. So what are the challenges that will be regarding the auditing of digital assets? Some of these things, when they ask you, you don't need to get the answer in any textbook. Use your mind and you'll be fine. Artificial intelligence and robotic information factors influence the development of auditing standards. The audit monitoring units of ICAG and the effect on quality of audits in Ghana. The role of Bank of Ghana, Securities and Exchange Commission, Ghana Stock Exchange Insurance Commission, National Pension Regulatory Authority in protecting the interests of the public and investors. This will also give you 10 marks. So we are done with the syllabus coverage. Any question before we move on to the questions I have in the intervention document? Any question? Any question? I'm not online. I'm online. Any question? Yeah. Nyamichi, you are here again. Mr. Nyamichi, can you ask your question? Mr. Nyamichi, can you hear me? Your hand is up. All right, maybe it is not intentional. So, oh, it's my network. Charlie. I don't know if Ada, Sister Nyamichi, you have asked your question. Can somebody hear me? Today, my network is fully.
Yes, please,
Yeah,
sir.
we can hear you now.
All right, okay. I believe we don't have any question. So let's move on with the question I have in the intervention document. Yes.
Sir.
Yeah, I can hear you.
Hello.
Yes.
Hello.
Yes, I can hear you. Sister Juliet, can you hear me? I believe others can hear me.
Yes.
Yes, sir, we can hear you, sir.
All
Yeah, we
right,
can hear you now.
all right, that's fine. So let's move on with the questions I have in the notes. So who will read for us? So I think I have about, yes.
Yes, I think she asked a question earlier, and I guess you dropped your call dropped, so you weren't able to hear.
Oh, okay, all
So I
right,
think
yes.
if I remember, is that she wanted to know if she wanted to know the interaction between key audit matters, emphasis of matter paragraph, and other matter paragraph, but like the clear distinction between these three. I think that's the question she asked.
Okay, let me take it. The interaction between the key audit matters, and which one?
Emphasis of matter paragraph.
Emphasis of matter paragraph. Okay.
And then I think she said other matter paragraph.
Other matter paragraph. Okay.
Yeah, so she wanted a clear distinction between these three.
I don't know if she's on the call or not.
I'm here, sir. I'm here. Please, I don't know if you can. I'm not being heard. Please, can you hear me?
Yes. I can hear. We can hear you.
Okay. Okay.
All right. So your question is the clear distinction between the key audit matters, emphasis of matter paragraph, and other matter paragraph. Okay. Now, for the key audit matters, it is normally done for listed entities, companies that are listed on the Ghana Stock Exchange. So if your client is not a listed entity, you don't bring in key audit matters in your audit report. You don't bring that. But if your client is a listed entity or other public interest entities, then you bring in key audit matters in your audit report. The things that goes into key audit matters is the same thing that goes into emphasis of matter paragraph. But the emphasis of matter paragraph is done for other entities that are not listed. So if your client is not a listed entity, your client is not any public interest bodies, then you don't bring in key audit matter. Public interest bodies like banks, financial institutions, and the rest. If your client is not that, then you don't bring in key audit matters. What you bring in is emphasis of matter paragraph. Now, the things that goes into key audit matters is the same thing that goes into emphasis of matter paragraph. Just that you bring in key audit matters for listed entities. Therefore, other entities, you bring emphasis of matter paragraph. Now, what will necessitate you to know the issue have to go under key audit matters? You see, for the key...
It's like say you're hearing another class.
So for the key audit matters, the standard requires that the issue must be first of all disclosed in the financial statement, just like the emphasis of matter paragraph. The issue is disclosed there. And you, the auditor, you think that, okay, users will need that issue in order to understand the financial statement. So you bring them under key audit matters for listed entities and emphasis of matter paragraph for other entities. So the standard gives some matters, issues that requires audited significant judgment, significant transactions, adoption of new IFRS or new standard. Issues that at the auditor, you think these areas are of higher risk. And those ones, definitely, they may have some form of effect on your audit opinion. So you want the users to know. So you bring them under key audit matters for listed entities and emphasis of matter paragraph for other entities. The other matter paragraph is the reverse approach. So the other matter paragraph, the issue will not be disclosed in the financial statement. The issue is not disclosed in the financial statement. And you consider those issues before you express an opinion on the financial statement. And you, the auditor, you think that, okay, those issues, you think that those issues will have effect on the reliance that users can place on the financial statement. So one issue is possible effect of limitation of scope. So if management limited your scope, they are not able to provide you access to the full information you need to conduct your audit. But first of all, you consider that before you issue the opinion on the financial statement. I gave you basis for modification. I said that if the limitation is material but not pervasive, you issue qualified opinion except for. But if the limitation is material and pervasive, you issue disclaimer of opinion. In that case, you cannot express any opinion on the financial statement because you were not able to conduct the audit. Management have restricted you access to all the information you need to conduct the audit. You write a report. You cannot say you will not write a report. You write a report, but your opinion will be disclaimer of opinion. The one you come under basis for opinion paragraph, you state it there that due to the limitation placed on our work by management, we were not able to express any opinion on the financial statement. Then when you come under other matter paragraph, you want users to know that you are not able to what? To express any opinion, even though you have stated it already under basis for opinion paragraph. You still want them, you still want to emphasize your work, you still want to elaborate more on your work. So you tell them that based on the possible limitation, the limitation placed on your work, you are not able to express any opinion. Another one is when the local law allows the auditor to elaborate more on his responsibilities. Then you can bring it under other matter paragraph. Auntie Jamichi, I believe you are fine.
Yes.
Yes. So
I'm
there's,
very fine, thank you.
there's a way you draft it. So know how it is drafted. Know how each of the paragraphs are drafted. Know
Okay.
how they are drafted.
Okay.
So for the
Alright.
key audit matters and emphasis of matter, I said that the auditor, you have to draw attention of users to the note in the financial statement. So you tell them that refer to, with reference to notes, maybe note 5, note 6, note 7, this, that, this. Then you state it. But if the issue is not disclosed at all, you consider that on your, before you express an opinion. Then you want to bring it again under other matter paragraph. All right. Any other question?
Okay.
Any other question?
Thank you, sir.
Do you have any other question? So the auditing, we are done from beginning to the end. We are done. What you need to pass your exam, I've given you everything. What you need to pass the exam, I've given you everything. We are done.
Thank you, sir.
The next one is we should take questions and see how we apply the talking I'm doing, blah, 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 blah. How do we apply it to answer questions? That's the next thing that is left that we have to do. That's all. Now, in answering exam and the exam, in answering questions in exam, every case question they will give you, at least, the first thing you do is, don't even start reading the question. If you do that, you'll be confused. You don't know what to do. So first, read the requirements. Know what is the question is asking you to do before you start reading. If you don't know the requirements, the audit questions can be long. You can read to the end. You don't even know what you have read. The time is ticking. By that time, your heart will start jumping. So first, relax yourself. Read the requirements of the question first. Every question, read the requirement first. It will tell you the things that you'll be needing. So while you are reading, you just be underlining those things. While you are done reading, first you do the proof reading. After you read the requirement, read fast. Scan through the question, read fast. In reading that fast, you know the requirements in your head already. So you know the things that you need to answer the question. So while you are doing that first reading, you can just be underlining them. Then now you have to start answering the question now. So the answering of the question, I always like the paragraph by paragraph approach. Every paragraph given to you, that you will see an issue in it based on the requirements of the question. Every paragraph that they will give you, you will definitely see something in every paragraph. So when you are done, they can ask you to state 5. Maybe state 5 audit risk. But in the question, you can have like 20 audit risk in the question. Somebody may use one paragraph and state all the 5 audit risk, and the person will be right. Somebody may use maybe 2 to state all the 5, and the person will be right. Somebody may use 3, or somebody may use all of them. So the answers will not be the same. So the examiners will make provision for all possible answers that the candidate can think of. And one way to pass advanced audit is to populate the exam, populate the paper. Write, whatever comes into your mind, pour it on the. It's one way to pass the advanced audit and assurance. Populate the exam, write, whatever comes to your mind, write. But don't write the thing to be in a story form. No. Write the thing, separate the thing, separate the points, separate them, write them point. It makes the marking easy for the examiners. But if you write a story, plenty, a story form, essay form, buying, they will find it very difficult to mark. So bullet the thing, let your marks, your answers be clear. All right. So we are taking the first question. At least we will do maybe 3 questions on the first part. Then we move to, even the questions I've even answered them. So this one, we can equally do it once, but we will discuss the answers. There may be more answers, other possible answers that we can bring on board, and everything will be right. All right, so who will read the questions for us?
Okay, let me read. Comment on the ethical and other professional issues raised in the above matters. Note, your answer should outline the threat arising, the significance of the threat, any factors you have taken into account, and if relevant, any safeguards you could apply to eliminate or mitigate the threat. Note, assume it is 6 December 2018, 10 marks. Now the question. Aventura International, a listed company, manufactures and wholesale a wide variety of products, including fashion clothes and audio video equipment. The company is audited by VOST,
Forget the
a
name.
firm
The
of
name there, don't mind the
chartered
name.
certified accountants, and the audit manager is Daros Hawkins. The following matters have arisen during the audit of the group's financial statement for the year to 31st December 2018, which is nearing completion. During the annual inventory count of fashion clothes at the company's principal warehouse, the audit staff attending the count were invited to purchase any item of clothing or equipment at 30% of their recommended retail prices. The chief executive of Aventura International, Armando Taylor, owns a private jet. Armando invoices the company on a monthly basis for that proportion of the operating cost which reflects business use. One of these invoices shows that Daros Hawkins was flown to Florida in March 2018 and flown back 2 weeks later. Neither Aventura nor then VOT have any offices or associates in Florida. Last week, Armando announces his engagement to be married to his personal assistant, Christine whatever, before joining Aventura in September 2018. Christine had been voiced accountant in charge of the audit of Aventura. Where do they get these names, Craig?
Forget the name, you can put your name there. But the only thing is when you are answering the question, make sure you use the names in the question so that the examiner will know what you are talking about.
Okay.
The name they are reading, you can just keep the names back. But when you are answering, relate your answering to the names so that the examiner will know what you are talking about. What you are read right now, each of them, the things are showing clearly. Is that not it? Yeah. Each of the scenarios, the ethical and other considerations, and other professional issues that's in the above scenario, they are showing there clearly. Your answer should outline the threat arising, the threat that is the portable threat, the significance of the threat, and any factors you have taken into account. If relevant, the safeguards. So this question is asking you anything: the ethical threats, the ethical issues, the threats that will arise, the significance of the threat, the factors you have taken into account, and how the threat should be mitigated. How the threat should be mitigated. So let's take the first paragraph. What is the ethical threat in the first paragraph? I put some possible answers over there, but if ignore those answers, let's discuss. What are the threats in the first paragraph?
Self-interest rates.
Self-interest rates.
Yes.
Can you explain, Senior, for us?
So from the case, you could see that the audit staff is invited to purchase an item at a discount rate. That means there's a financial gain here, of which it may have an influence on the audit staff during the audit opinion, maybe they may not be objective because they're receiving some financial benefit, a discount of 30% on the invitation they had.
Thank you, senior. That is it. Offer of the goods. It is not wrong. It is not wrong that you give auditors you give them the chance to buy some of the goods, but the price should be on the commercial terms, the commercial price. You see the case, they said they were what? The audit staff attending the count were invited to purchase any item of clothing or equipment at 30% of their recommended selling price. It means they are giving them discounts of 30%, so they only be paying 70%. Is that the recommended price? That is not the recommended price. You can allow them to buy, but the price should be the arm's length price. The price should be the current market price you are selling. So that is the threat of the self-interest threat over there. The second paragraph. Let's go to the second paragraph.
Sir, I think I have another thing with respect to the first paragraph.
Okay, all right, Bringo. I say one paragraph, you can get more.
Okay, so it has to do with the integrity of the client. You see,
Okay.
it's questionable here because you see, you are offering the auditors some kind of incentive so that they'll be lax on their performance in the audit performance. So their integrity is questionable. Says
All right.
it.
Yeah, thank you very much.
Very
perfect. Very perfect.
Can we get gifts and hospitality?
Come again.
Can we also use gifts and hospitality?
Will it be a form of gift and hospitality?
Because they're giving them a percentage, which is not supposed to, so it's in the form of like a gift.
No, that will not really work.
Okay.
That will not really work. It's not a gift and it's not a form of hospitality too. It's just a discount they are giving them below their recommended price, which our colleagues have said it's the integrity of the client is also at stake because they are offering them the 30% discount, which shows that they may be trying to influence those attending the inventory count. They may be trying to influence their objectivity. So their client's integrity will also be questionable. Then the self-interest, the financial interest is also there, but hospitality will not fit appropriately. What other thing again?
Sir, I think issue with respect to practice management.
Okay.
So you see, if the audit firm have put measures in place that their auditors, when they go out to audit these firms, they shouldn't take anything from them. They have to put controls in place, like measures so that they shouldn't like have any dealings with the client.
Okay.
If they have measures there, they won't even accept that 30%.
Oh, they have not accepted. They have not accepted yet too.
Oh, okay.
Oh, they have not. They have not. They
All
just
right.
they
Thank you.
offered them. So that's what you would tell. But what you are saying is not wrong. It's in place. What you are saying is in place. But just the only
Okay.
thing is don't assume that they have accepted the offer. No.
Oh, okay, okay.
If they will accept, what are the ethical implications? Then you talk about it.
Okay, thank you.
All right. Thank you too. So let's go to the next paragraph. But are we answering the question? They said, so we have identified the threat, significance of the threat, and any factor you have taken into account, and the safeguards. So what will be the safeguards? What will be the safeguards available? What should be the safeguards available? Oh, so what safeguards would the audit firm use? What will be the best safeguard that you use? Oh, this one is simple. Should they accept the offer?
No, they shouldn't accept the offer.
Yeah, they should not even accept the offer at the first place. So that is the best safeguard, because looking at it, they are giving you 30%, which will try to influence your objectivity and the integrity of the client, and you yourself, your integrity is at the, so they should not even accept the engagement at the first place.
Okay, so can I also say that the audit firm should be training their clients with respect to things like this?
Oh, yes, yes.
Like,
oh, yes. That's the practice management you are talking about.
yes, sir.
So they should normally be training their clients, educate them on acceptance of this form of discount, this form of gift, and such items in question. It's that is appropriate safeguard. But you see, this benefit they are giving to them. If like this benefit is given to all staff of what the name of the company is, Aventura International Limited. If like every staff they are giving them this 30%, it means that everything, that's what they're giving to everybody. That is even fine. But this one is given to only the audit staff. Those that are attending the count, the inventory count, they're giving to only those people. So that benefit is not even appropriate. All right. Let's go to the next paragraph.
Hello, sir.
Yes.
So in answering this particular question, do
Yeah.
you go by drawing your table, the threat,
no.
the significance of the threat, the factors leading to that threat, and then the safeguard? Do you do it like that?
You can do it like that, or you can do it paragraph by paragraph. You can just exam. This is professional exam. Drawing table in professional exam. This is not academic exam. So leave that table thing. Just answer paragraph by paragraph. Now you are good to go. Answer paragraph by paragraph. Then you are okay. All right. So let's go to the first. The B. What's the B? What's the Roman number 2 talking about? It said the CEO of the company owns a private jet. The CEO is, what's the name of the CEO? Armando. Okay, invoices the company on a monthly basis for that proportion of the operating cost, which reflects business use. So the man used the private jet for business use. The man is enjoying it. And he gives Aventura International Limited invoices of the cost that he used on a monthly basis. Okay, one of these invoices shows that Darius Hacken was flown to Florida in March 2018 and was flown back 2 weeks later. Who is this person? Who is Darius Hacken? Who is that person?
The audit manager.
He's the audit manager. So he was flown to Florida. Charlie, the man go and chill for 2 weeks and flown back in 2 weeks' time. Neither Aventura nor Voice, which is the audit firm, have any offices or associates in Florida. So what did the man go to Florida to go and do?
Let's chill.
He just went and chill with the big boys.
To go and chill, yes.
So what's the ethical trade there?
So here, self-interest threats can also affect it.
What
Because in this case,
What threat?
self-interest.
Okay.
Because in this case, the auditor has also been given the opportunity to fly with the executive officer. And with this, it can affect the independence of the audit firm.
Okay. All right. What
I
is
say,
it?
I can say there is issue with practice management because you, as an audit manager, I mean, you shouldn't be having this. I mean, the firm hasn't put in measures in place to train these auditors very well. Because if they were trained very well, I don't think you would even take that offer to fly to the Florida, and which is not in connection with the audit process.
All right. Thank you very much. So what did the man go there and go and do? That is a question.
No, sir.
Yes.
Sir, please, can you talk on independence? That's the Darius Hacken. Since he's the audit manager of the firm of chartered accountants, he's not being independent. I don't know if it's part of the professional issues.
Independence,
I think familiarity.
but the way you explain it, the independency will not work here. No, let me just clear that doubt in your mind at once. Just that there's no issue of independence. No, they are not influencing his work. The manager is not influencing his work. No. Just that the man was flown to Florida for 2 weeks to go and do nothing. There was no work there. He just went there and came. So that's a form of hospitality. So the person who was talking about the hospitality, this is where you can bring the hospitality in. He went there and came back. For what? For no work. And the CEO invoiced the company that cost to pay. What is the essence of that cost? That's what one of our seniors said, that there was issue with practice management. There's no proper practice management here. There's no proper quality control measures in place regarding this audit. If not, the audit managers will not take that flight, go to Florida and go and chill for 2 weeks and come back. So don't bring any issue of independency here. Now,
Okay,
what? Yes.
Okay. Well, I wanted to also talk about the integrity here again.
Okay.
I think maybe the client is hiding some things. That's why he's letting us enjoy all these benefits. So like he'll be hiding something because it's like he's making them enjoy too much. What do you think?
Oh yes, it could be. But you see, that one alone should not affect the independency and the objective status of the audit manager. They can do that. But if Darius know, you see, these are the issues you consider. If you know that going to that Florida and coming back will affect his independency and objectivity, then he should not go. He shouldn't even accept it. But first of all, he should not even go there. Because as an auditor, there is no proper practice management in place over here. But it's true, the firm may be hiding something. That's the reason why they are trying to provide this form of hospitality to the audit manager, so that he will not come out with all the issues. Yes, it could be very possible. Whatever you have in your mind, write it, but make sure you link the thing to the case. You will be fine.
Yes, sir.
All right. Let's go to the last one. Last week, they said last week, Armando is the CEO, announced his engagement to be married to his personal assistant, Charlie, this man to wife, before joining Aventura in September 2018. I mean, he joined not quite long. Okay. The lady has been, the lady is even an accountant in charge of the audit too, Charlie. This one, this one is abomination. You don't do this one. Eh? The CEO, no, you want to come and marry your audit man, accountant in charge of the audit. So the CEO is the accountant, the lady. Christine is the personal assistant to the CEO. And she is the accountant in charge of the audit. So she is like the liaison person in charge of the audit. Who want to be, who the CEO has engaged in. What are the ethical issues here?
So I see familiarity threat, which will affect the auditor's independence, because since he's connected with the CEO, then some familiarity will happen there. Anna.
Oh yeah, it is very possible. Familiar
Yes, confidentiality.
Familiar that they are familiar, related party issues. You see, the family, this one, this engagement is between the CEO and the accountant. The CEO and accountant. And it's not between the CEO and the audit firm, no. This lady is not the auditor. Christine is not the auditor, no. She is just the accountant in charge of the audit. Darius is the audit is the audit manager. This lady is the accountant of the company. Is the accountant of Aventura International Limited.
Yes, okay. I didn't get it right.
Yes. So first analyze the question before you start answering.
Yes, sir.
Somebody said there'll be confidentiality, right?
Yes.
Yes. But see that familiarity is not wrong. But it's there because if the CEO and the accountants are married, how would the CEO be able to supervise the work of the accountant, the wife?
Oh, because, okay.
Yes, it is there, but it's how you explain it.
Yes, sir.
Yes, it's how you explain
it. Can family and personal relationship be there?
Family and what?
Personal relationship.
Oh, yes. It could be there. Yes.
The person in charge of Was there maybe they had a relationship before, after the audit?
Is he after the audit? No, they are in the process.
Before, during the audit.
Yeah,
During the audit period.
yes. During the audit. You see, this man joined, the CEO joined, they say what? Okay. Last week, Amando announced his engagement to be married to his personal assistant, Christine Femimo, before joining Adventura in September 2018. Christian had been the accountant in charge. Okay. Christian is the okay. Charlie, this lady, Senior Samuel.
Yes, sir.
Charlie, your first interpretation is in point. I didn't see the audit firm here. Is the voice is the audit firm? Is the voice accountant in charge of the audit? Yes. Yes. So this one, the familiarity is there clearly. A related party issue. Somebody said related party issue is there. Yes. So how will you solve this issue? What are the
So I think
you apply?
the lady should recuse herself from the audit.
All right. The lady.
I think that the work should be subject for review.
Okay, the work can be subject to independent review. That's fine. But Senior Samuel, you said something.
I was saying that the lady should recuse herself from the audit.
Yeah, so the auditing firm to change the lady. They should change the lady from being the accountant in charge of the audit.
Exactly.
Yeah, they should change the lady from being the accountant in charge
Hello,
of the
sir.
audit.
And even the lady herself was supposed to have disclosed that.
Yeah. I can hear you.
But I say the lady is now the CEO's personal assistant. So
Yes.
it's not like
So he's no more with the audit
job.
firm.
He's no more with the audit firm, eh?
Yes, before joining Aventura. So it means he has resigned from the audit firm, but now working as personal assistant.
Okay. Charlie, it's English, bro. Okay. That means okay. So this one, what will be the safeguards? But the threats we are talking about, familiarity, related persons, confidentiality, all those threats will be there. Self-review threats will be there. Self-interest threats, all of them will be there. But what is the possible safeguards that should be applied? Somebody too was saying something. Is it Sister Juliet or Sister Crystal?
I've already said my own.
Yeah, you've said your own. All right. The solutions I put here, if you have time, read through. It will guide you on how to go about the questions. Let's go to question 2. But all that we have discussed so far, they are all in place. Everything is in place. All right. So although auditors can incur civil liability under various statutes, it is more likely that they will incur liability for negligence under common law, as most cases against auditors have been in this area. Therefore, auditors must be fully aware of the extent of their responsibility to minimize the danger of potential or professional negligence claim. You are required to discuss 5 steps the auditor should take to minimize the danger of claims against them for professional negligence. So, what are the steps that auditors can take to make sure that they avoid that negligence under the civil law? What are the steps they can take?
So obtain professionals.
They should do what?
They should obtain professional. No, that's good. I forgot them.
Sister Juliet, come again, please.
Yes.
Professional
indemnity insurance.
Okay. So they should limit that one is they should meet the liability. So they should do professional indemnity insurance. Okay. All right. But this question is basically on practice management too. So
Hello, sir.
quality control. What are the quality control steps? That's all. Yes, I can hear you, sister.
Hello, sir. Please, in this case, I need to join the avoiding the liability, meeting the liability, and limiting it. Can you make it like one, or you should just, for example, avoiding the liability, then you just state the points. Then
No, what you do is don't state to avoid liability. Don't do. Under all of them, there is ways that they can use to avoid the liability. Is that not it? So write them, just write them like a point. If you get 5, you are good to go. You can take limit the liability. How do they limit the liability? Write them. Meet the liability. That's what our sister said. They should do professional indemnity insurance. It's a step. So don't say
okay, sir.
avoid liability, limit that. No. Just write the points. So you can take the 3. How the 3 will be done, any of them, write it, and then you are good to go.
Okay,
So,
sir. Thank you.
So I said agreements concerning the duties of the auditors should be clear and precise. It should be in writing. It should confirm by a letter of engagement. So before they will sign the engagement, their duties should be clearly specified in the engagement. Management should understand their responsibility, that it is their duty to prevent and detect fraud and error. That is not the duty of the auditor. It should be clearly stated in the engagement letter before it will be signed, so that when the auditor is not able to detect fraud and error, management will not be saying it is your duty to determine fraud and error. You have not determined it. No. So the duties of the auditors should be clearly specified. It should be in writing in the engagement letter before the engagement letter will be signed. Audit work should be relevant to the system of internal controls. So you do all quality control measures. You should plan your audit adequately. So all of them, you'll be able to avoid the negligence form of liability. Discuss 4 strategies you recommend to management to help mitigate or prevent a conflict of interest situation at workplace. So there are conflicts of interest situations at the workplace. We know conflict of interest. Someone is in position. Then you are trying to use your position for your personal gain, for your personal interest. That's a conflict of interest. You are the CEO of the company. Now they want to do recruitment. They want to employ accountants. You say, oh, accountant should be my wife. My wife is there. My wife does not have any work. So I'm bringing my wife in as the accountant. That's conflict of interest. You are using your position for your personal gain, for your personal benefit. That's conflict of interest. So what should management use? What are the strategies they should adopt to help them prevent conflict of interest situations at workplace? So I say what they should review the employee handbook. So most organizations dictate a section of the employee handbook to describing what a conflict of interest is for the organization, how you can avoid them, and what the consequences are if you knowingly engage in conflict of interest. So in the employee's handbook, it should be clearly stated. You tell them this is the conflict of interest situation for our organization. This is how you can avoid it if you engage in it. These are the consequences that you are going to suffer. It should be clearly stated in the employee's handbook. Report of conflict of interest situations. So there should be a reporting line. So if you know that a co-worker or a manager is engaging in a conflict of interest, consider taking the appropriate steps as outlined in your employee handbook. So there should be that reporting line, how the conflict of interest issue should be reported. Then disclose. One of the best way to prevent conflict of interest is by disclosing your relationship and potential conflict with management or human resource. So if you are the employee in the organization, if you have any relationship with the managerial positions of the organization, those that are in managerial position of the organization, you have to disclose all of them. Disclosure is one best way of preventing conflict of interest. So that's the reason why even auditors, before you assign any auditing members to any engagement, all of them have to fill that conflict of interest form. There's a form, determination of conflict of interest. So we want to know where we are going to audit. do you have any relationship with the management of the organization? So if you have any form of relationship, then first of all, we will not even include you as part of the audit team. So you remove you so that we prevent the conflict of interest situation. So disclosure is one best way of preventing conflict of interest. Let's go to question 3. Somebody read the question 3 for us.
Okay, question 3. Please, the requirement.
Yeah, read the requirement. Can you see?
Discuss the stance taken by the directors of the company.
Okay.
Question 3. Assurance and Associates have completed the audit of the account of Enosewa & Co. Limited for the year ended 31st December 2015. The auditor's opinion on the financial statement has been favorable to Enosewa & Company Limited. Internal checks procedures after the audit revealed a shortage of cash of 2 million Ghana cedis. The directors of Enosewa & Company Limited put a freeze on the payment of the audit fees on the grounds that the audit could not detect the shortage required. Discuss the stance taken by the directors of the company.
Okay, all right. Who is doing the discussion for us? You see, that's the reason why I said earlier that in the engagement plan, the duties and responsibilities of management and auditors should be clearly stated. Management should know their duties and their responsibilities. Management should also understand the work of the auditors before the engagement letter will be signed. This thing that these people are doing, these directors have decided to do. The central check procedures after the audit revealed a shortage of cash of 2 million Ghana cedis. Directors of the company put a freeze on the audit fee on the ground that the audit could not detect the shortage. Is it the responsibility of auditors to determine the shortage of the cash of 2 million? Is it their responsibilities? Is it the responsibility of auditors?
No.
Yes. So that's the reason why in engagement letter, they should understand clearly. Directors should understand clearly that it is their duty and responsibility. Guys, 1 minute, I'm coming. Number is all.
Is all.
All right, guys, let's move on. So somebody should discuss the stand taken by the directors of the company. Somebody should just give us a brief discussion on it, then we move forward. Or if possible, we should read the solution I put here. Let's read it. So, Auntie Namiche, can you read the solution for us? The suggested solution I put here.
Okay, suggestion solution. Responsibility for prevention of fraud management. 1. The responsibility for the prevention of fraud, other irregularities and errors rest with management. Management has the fiduciary role So your Kesa, okay, of safeguarding assets, since the directors of a company are regarded in law as acting in stewardship capacity concerning the property under their control. Management.
Yeah, read, let's go. Yes,
management can discharge these responsibilities by adopting methods such as 1, the installation of an effective accounting system. 2, the institutions and the operations of an appropriate system of internal control. And 3, ensuring that employees understand and comply with relevant codes of conduct.
Okay. Let's go.
Then, maintaining a register of relevant legal requirements and ensuring that operating procedures and conditions meet the required standard. The establishment of an independent internal audit functions and the appointment of audit committee. So responsibility for detection. Okay. Should I continue that?
Yes, let's move on.
The primary responsibility for the detection of fraud, other irregularities and errors rests with, I've done this one. Management. The role of detection is an extension of its role in preventing. Auditor. The auditor is not responsible for preventing fraud, other irregularities or errors. Audit procedures should be designed to give a reasonable expectation of detecting any material misstatements, whether intentional or unintentional, in an entity's financial statements. The auditor cannot prevent a fraud or other irregularities from occurring. However, the annual recurring audits may act as a deterrent. The auditor is to report to management when he identifies significant weaknesses in the structure of accounting and internal controls and deficiencies in their operation. The auditor's responsibility regarding the detection of fraud, other irregularities or error is to plan, perform and evaluate his audit work so as to have a reasonable expectation of detecting material misstatements in the financial statement, whether they are caused by fraud or other irregularities or errors. On the basis of the above, it is wrong for the directors to refuse to pay the audit fees if it is found that the auditors are negligent in their performance of duty. Then the directors can bring a charge against them in court or file a complaint with ICAG.
All right, thank you very much. So you see the way you have to answer the question. So this question is on responsibilities of auditors and management. So the best way is tell the examiner that you know the responsibility of auditors, the responsibility of directors. Then you conclude. So on the basis of the responsibilities of auditors and management, it is not right for directors to refuse to pay the audit fee. They can only do that if they find out that the audit was performed negligently. If they find out that the audit was performed negligently, even that one, they cannot refuse to pay. They have to pay. Then later they can file a case against the auditors. So the best way is tell the examiner the responsibilities of management, responsibilities of the auditors, before you have to what? You have to conclude. All right. Question 4. Let's move on. So read this document. I've given you answers to all the questions. Take your time and read, and you'll be fine. There's no way you will not pass the exam. Question 4. Let's move on.
Question 4. The potential liability of auditors has become an important topic in recent years due to the growing complexity of the audit business environment and an increase in legal actions against auditors. One argument put forward to explain the high number of legal actions against auditors is the expectation gap required. Explain the audit expectation gap and the elements in the gap. I recommend 2 ways of closing the audit expectation gap. I recommend 4 approaches or ways that the professional practice firm and auditors could adopt to create the awareness of the importance of professional skepticism and its application.
All right, so we know about the audit expectation gap. So this question is asking you to explain the audit expectation gap and the element in the gap. And the element in the gap. So the gap is the differences between what the users of the financial statement think that the auditor should do and what actually by law and what actually is required by law for the auditors to do and the profession for the auditors to do. So that gap is there. What the auditors are thinking or what the users of the financial statement and other members of the public are thinking is different from actually what is the work of the auditors. So that is the gap. So we have 3 elements of the gap. We have the standard gap, we have the performance gap, and we have the liability gap. You should be able to explain the 3 of them. So the standard gap occurs because of a perception that auditing standards are more prescriptive than they actually are, and that auditors have wide-ranging rules that they must follow. So the standard gap, the other members and users of the finances are thinking that actually they can predict what the standards are, what the standard are. They can predict the outcome of the work based on the auditing standard. They can predict it, but that is not actually the case. Performance gap occurs because of perception that the audit work has fallen below the required standard. So outsiders are thinking that, okay, the performance of the audit has fallen below the required standard. Meanwhile, they don't know the required standard. They just have that perception. They just have that thought that the auditing work has fallen below the required standard. Meanwhile, they don't know the standard. So that is creating the performance gap. The liability gap arises from lack of understanding that the auditor's liability and who the auditor may be liable to. So because of the performance gap, the liability gap, the outsiders, because they don't know the roles and responsibilities of auditors and management. So if the auditor fail to detect any misstatement, any fraud in the financial statement, they are thinking that it is the auditor who is supposed to be liable for not detecting those misstatements in the financial statement, for not detecting that fraud. So they are thinking that the auditor will be liable for not detecting fraud in the financial statement, for not preventing fraud in the financial statement. But that is not what the standard says. That is not what the profession as the auditing says. Now, closing the gap. Let's discuss closing the gap. How do you close the gap? How do you close the gap? How can we close the audit expectation gap? Can you close the gap?
We can do that by way of education. So we can educate the users so that we can reduce the standard gap, because they think that they can predict the standard. So we can educate the users on the financial statement so as to reduce the standard gap.
Okay, all right. So education is there, education is key. So you educate the public on what actually is the responsibility of the auditors and that of management. But who will help to do that education? Who will help to do that education? Who will help to educate the members on the rules and responsibilities of auditors and management? Who will do that?
The institute, ICAG.
Okay, the ICAG should be able to do that. The Institute of ICAG Ghana should be able to educate the public on the responsibilities of management and that of auditors. Who else can do that? Who else can help us to do the education? Can we use audit committee? Can we use audit committee to do the education? Can audit committee help to educate the members of the public? All right. So audit committee can equally help. The monitoring unit of the ICAG can equally help. So that's the Institute of the Chartered Accountants Ghana. All right. So what I have here is what we have in the textbook. By an exam, if you will not be able to you cannot remember them. So the education is key. But just that expand it. Expand it. The controls over the auditing profession are important in enhancing public confidence. So education is very, very key. All right. The third one is on professional skepticism. What is the question? Let me see the question. The third one, the third requirement, recommend 4 approaches or ways that the professional practice firms and auditors could adopt to create the awareness of the importance of professional skepticism. First of all, what is professional skepticism? What is professional skepticism?
So professional skepticism here is when the auditor is having an ongoing or maintaining an ongoing questioning mind, and is also staying alert to the possibilities of fraud, misstatement, or error during the conduct of his audit work.
Okay. So what are the areas? What are the areas that the auditors have to exercise professional skepticism? The most important areas. What are those areas?
The treasury.
What is treasury, madam? Treasury, can you explain, please?
So treasury is cash collection, payment.
Now, okay. All right, thank you very much. So, especially selling on cash basis. When you are selling on cash basis, means that definitely there's a risk there that definitely all the cash may not be banked. Some way, somehow, some of the cash will jump, will fly into the pocket of somebody. So auditors, you have to have that open mind, that questioning mind when you are auditing cash payments and cash transactions. What other areas? Normally, the areas that the auditors requires to be of higher risk, those areas, the auditor, you must exercise professional skepticism. Auntie Jennifer. Yes. Oh, you are here? Oh, that's good. Issues of IAS 8, accounting estimates. Estimates. The auditor, you must have that professional mind, that you must exercise that inquisitive mind. Issues of going concern. You must have the professional skepticism. Significant transactions and events. You must exercise professional related party transactions. You must have professional skepticism. Now, the question is 4 approaches or ways that the practice firm, that accounting firm should adopt to create awareness of the importance of application of professional skepticism. How can they do that? That's what the question is trying to seek. So 4 ways. So Auntie Nyamiche, can you read the suggested solution for us?
Question 5, please.
It's not question 5. The requirement for the question, the Roman number 3, professional skepticism.
Okay, so professional skepticism within the engagement team is also influenced both by the actions of the firm's leadership and the engagement partner, and by the culture and business environment of the firm. The ISAS and ISQC1 include requirements and guidance designed to help create an environment at both the firm and engagement levels in which the auditor can cultivate appropriate professional skepticism. For instance, 1, auditors must consider the integrity of the principal owners and management during engagement acceptance. 2, the auditor must consider the reasonableness of significant assumptions used by management for accounting estimates, giving rise to significant risk. ISA 240 relating to fraud. Note that the auditor must maintain an ongoing questioning mind and be alert to the possibility of fraud. 3, okay, again, when considering going concern, the auditor must consider the reasonableness of assumptions and whether management plans are feasible in the circumstances. Another area where professional skepticism is particularly important is in relation to auditing significant, unusual, or highly complex transactions. ISA 330, ISA 3 page. The auditor is required to document how they have applied professional skepticism.
All right, thank you very much. Thank you very much. All right, so we are wasting more time on the question on the professional and other considerations. The rest of the questions have the answers to them. So kindly take your time and read through. I have the answers to them. I want us to move on to audit of historical financial statements. Audit of historical financial statements, yes. We have done basically 3 hours now, and we have not gotten to anywhere. So the rest of the questions I have the answers, so solutions there. So just take your time and read through and you'll be fine. Let's move on to audit of historical financial statement. Yes. All right, so are you guys tired? Should we take a few minute break? Because if the thing is,
no, let's continue.
we should continue.
We can break for a while, then we come back.
Some few minutes break.
Some few minutes break.
Some few minutes break, yes.
Okay. So let's take 10 minutes break. It's now 5 o'clock exactly. So when it's 5:10, we'll come and continue with audit of historical financial statement.
Financial statement.
All right, so let's take the first question, audit of historical financial statement. So under the
let
audit,
me read the requirement.
Yeah, you read the requirement. You read the requirement. So that we know what is expected of us. The question quite is plenty. What is that? By the time you finish reading this, you are tired. So read the requirements, the first requirements. Let's go.
I. Identify and explain the key business risk that exists at Go Shop. I. Explain what is meant by the business risk approach to an audit. I. Using the information provided, identify and explain 5 risks of material misstatement that may affect the financial statement you are going to audit.
Oh, okay, all right. Forget about the marks. So these are not the required marks for the question. How can this one be 2.5 marks? This is not right. So forget about the marks. This question will give you, it's a full 15-mark question. It's a full 50-mark question. So we are to identify and explain the key business risk that exists at Go Shop. So the first one is the key business risk. We know about the business risk already, so we should identify them and explain them to the what? Link them to the keys. Then we have to explain what is meant by business risk approach to audit. We are going to use business risk approach to audit. What does it mean? Then the last requirement, we have to identify and explain 5 risks of material misstatement. So these are financial statement risk that may affect the financial statement you are going to audit. So when we are reading the keys, let's have the requirements in our mind. When we are reading the keys, let's have the requirements in our mind. All right, so Auntie Nyameje, kindly read the case for us.
As audit senior, you have recently attended a meeting with the managing director of Go Shop Company and the new audit partner assigned to the audit, Mike Ketten, who has recently joined your firm. And okay, so there are 2 people. The audit partner is familiarizing himself with the client. Go Shop Company is a large limited liability building company set up by John Yams, who has been managing director since incorporation. It operates in the south of the country, purchasing land outside of major towns and building retail parks, which the company then manages. You are familiar with the client as you have taken part in the audit for the last 3 years. The other key member of the board is Kathleen, who set up the business with John Yams and is finance director, sorry. Kathleen is a qualified accountant, and the accounting system and procedures at Go Shop Company have always appeared sound.
Okay. Let's move on.
So you took minutes of the meeting, which are given below. Minutes of a meeting between Mike Ketten and John Yams, 30th March 2022. MK introduced himself to JY and asked for a brief history of the business, which was given. Currently, the majority of income is from the property management side. As the building market is becoming saturated, with interest rates set to rise, John Yams is less keen to borrow and build in the current climate. MK asked John Yams whether a recent spat of tourist bomb attack had had any effect on business. John Yams commented that he had been given the impression that retail was down and that customers were staying away from the retail centers. But he felt that some of that could be attributed to a rise in interest rates and was likely to be temporary. The first months of the year are always poor for retail. MK asked whether there had been a rise in empty units in the retail centers. John Yams said there had been a small rise. MK asked JY about his views in relation to the current proposed legislation before the government concerning quality standard in the building trade. JY commented that it seems like a load of nonsense to him. It seems like a load of nonsense to him, and expressed some dissatisfaction with the current political situation. MK pressed the matter, inquiring as to John Y's opinion on the likely effect on his business were more stringent standards to be required in the future. JY is of firm belief that it will not be passed. MK expressed his fear that the legislation. Yeah, you've gone far.
I've gone far.
Yeah.
It's feared that the legislation was more than likely to be passed.
The legislation was more than likely to be passed and would have far-reaching and expensive effect on most builders in the country. JY repeated some of his previous comments about politicians. MK inquired as to whether there were any anticipated development in the business that he should know about. JY made reference to KH plans to retire from full-time work in the business. MK asked how JY was going to replace her. JY commented that he was hoping to persuade her to stay on as she deals with all the financial side, and he will be lost without her. MK tried to inquire how firm her retirement plans were, but JY was not forthcoming. Very beautiful. After the meeting, my curtain asks you to ring Kathleen and discuss her plans. She confirmed that she does plan to retire. She informed you that her plans to immigrate to Australia and is not the let me take it again. After the meeting, my curtain asks you to ring Kathleen and discuss her plans. She confirmed that she does plan to retire. She informed you that so her plans to immigrate to Australia and is not keen to put back her plans. I think something is missing here.
No, she
She
informed you
adds
that
up
she plans to immigrate to Australia and is not keen, and she's not keen to put back her plans.
back her plans.
Yes.
She asked about the possibility of E and
East
P
Lake.
assisting, East Lake and Pond assisting in the recruitment process for her replacement. As she does not feel that John Yams has the technical ability to recruit someone without her, and has not accepted her plans enough to recruit before her retirement. She said that she has even wondered about the possibility of someone being seconded to the company from East Lake and Pond to cover her position after she has left and before her replacement is found. Mike is keen to reappraise the audit strategy taken towards the audit of Go Shop, as he feels the audit could be conducted more efficiently than it has been in the past. Historically, the audit has been highly substantive.
Thank you very much for the reading.
Record. Should I read the recurring text?
No, it's okay. It took a long of time, a lot of energy to read this question because of this. This is ACCA question. So you see that these names are not familiar with we the Africans. It's an ACCA question. So, but when you look at the question, the risk were clearly stated in the case. So at least each of the paragraph, you should be able to identify a risk. As we are reading, I was identifying some, now writing it closer attached to the paragraph. You see, one risk I've identified is compliance risk. They say business risk. Business risk, I gave you what to write in the exam: operational risk, compliance risk, reputational risk, strategy risk, and the rest. I've identified compliance risk here because they said there is a proposed new legislation that will be introduced by government. And this new legislation, the company must comply with it. The company must comply with the requirements of the new legislation. And if new legislations are coming in, the compliance with that new legislation will take time, and it will be cost effective because the company have to get much cost in order to comply with to meet the requirements of the new legislation. So there's a risk. You see, the statement continues. You see, they say inquiry as to JY's opinion on the likely effect on his business, where more stringent standards will be required in the future. JY is of the firm belief that it would not be passed. The legislation will not be passed. You see, MK expressed his fear that the legislation was more than likely to be passed. So when the legislation is equally passed, there will be a compliance risk on the operations of Go Shop. This is one risk I've identified. I've identified another one: loss of key personnel. Loss of key personnel. You see, this one, they said the woman is the finance. What's the name of the woman? So while you are explaining, link it to the case. Use the name of the persons in the case. They said a certain woman want to retire. What's the name of that woman? You see, the business is about to lose a key member, a key customer.
She's called Kathleen.
Kathleen, yes. They said J1 may refer to Kathleen's plan to retire from full-time work in the business. And MK asked how JY was going to replace her. And JY commented that he was hoping to persuade her to stay on as she deals with all the financial side. And he would have lost without her. So it means that the statement continues that the company have no plan to replace her. So there's a business risk over there, over reliance on a key customer. So loss of key customer. So this woman is leaving. The business does not have any plan to replace her. So it means that when she finally retires, the financial issues of Go Shop will be what? There will be nobody to manage the financial issues of Go Shop. That is a risk. That is a risk. Has anybody also identified any risk? Has anybody also identified any risk? Tanyamichi, have you identified any risk as you are reading? You see, there's even operational risk. There's operational, that is the industry that Go Shop is operating in. They said the market at the building. Yeah, John, John, your hand is up. Senior John, your hand is up. All right, let's move on. They said the building market is saturated. I mean, the market is volatile. The market is volatile. So there is an operational risk over there, which is the industry in which the building is operating in. So the building market is generally considered, the industry is considered to be very volatile because of changes in interest rates, with interest rates set to rise. JY is less keen to borrow and build the current climate. And there will equally be what? Financial risk over here. Because the building, most of the things. There will be finance risk. There will be finance risk over here. Because the business is located in the very volatile industry. Interest rates keeps changing. Interest rates keep rising. And the company, the managing director, JY, is keen to borrow and build in what? In the current climate. So it means that the money that he will invest in building, which is the shop, the real estate business, is going to borrow the money. And the money, the interest rates are always on the rise. So there'll be financial risk over there. There'll be risks that the business will not be able to pay the interest on the loan that they will take. That is a financial risk. And I spoke about the operational risk, which is the industry, that the industry is very volatile. They say the market is saturated. I mean, there are constant changes in the market. Any other risk again? So that is 4. I think those are the 4 risks that is affecting the shop. Now, explain what is meant by business risk approach. You are going to use business risk approach to do the audit. So, you are going to conduct the assessment of the business risk. So, it's an extension of the audit risk approach. So, while you're using the audit risk approach, the auditor focus their attention on the matters that are most significant to affect the auditor's issuing opinion on the financial statement. But if you use the business risk approach, it focuses on the issues, the factors that will prevent the business from achieving its objective. If you read the last sentence, it says Mike is keen. Mike is the audit partner. Is keen to reappraise the audit strategy taken towards the audit of Go Shop, as he feels that the audit could be conducted more efficiently than it has been in the past years. Historically, the audit has been highly substantive. So Mike is now contemplating on other auditing strategies to use to conduct the audit of Go Shop. Now he's saying we should explain what is business risk. So the business risk is an extension of the audit risk approach, whereby the audit focus on the operational activities of the organization, the activities that are likely to affect the organization from achieving its objectives. Now you are using the information to identify and explain. Explain what? 5 risks of material misstatement that may affect the financials statements of the audit you are going to do. Now, I said earlier that there is a link between the business risk and the financial statement risk. The higher the business risk, the higher the risk that there will be a lot of misstatements in the financial statement. So the issues that we have identified, the compliance, the business risk, the compliance issues, the operational issues, the financial issues, and the loss of key personnel. All those things will lead to material misstatement in the financial statement. So the first requirement is we are to explain 5 risks of material misstatement that will be determined, that will affect the financial statement of the audit we are going to do. So what are some of the financial statements? So material misstatement risk are the financial statement risk. So what are some of the material misstatement risk? What are some of the material misstatement risk? Are we together? Can somebody hear me? Can somebody hear me? Or my network is off again.
Okay, so we can hear you.
I can hear you.
Okay, all right. So let's move on. So the material misstatement risk, we spoke about loss of key customers. And this is the only person that is handling the financial statement of the company. And when she leaves, the company is not in position to employ anyone to replace her. So it means that that person, she is the only one who have the knowledge of financials, of preparing the financial. And once she leaves, there's a risk that the financial statement will not be prepared in accordance with applicable financial reporting framework. So there may be overstatement of expenditures in the financial statement. There is financial risk too. So there's a risk that they are going to take loan, and the financial risk, as I've explained in the business risk, the interest rates keep on rising. And when they take a loan, there's a risk that the interest rate will fluctuate and the company will not be able to what? To settle the interest on the loan, which will affect the operational activities of the business. So going concern issue 2 may come in. The compliance side, you see, the new legislation that the government is planning to introduce, and the manager is saying that he have a possibility that the law will not be passed. And what if that law is passed? There will be compliance issue, as I've explained under the business risk. So the financial aspect is that the cost that they will need to make sure they implement the new legislation, there will be overburden of the financial aspect of the liquid resources of the company. So just link them. You are good to go. So I have the solution here, the requirements here. Okay, you have loss of key customer, financial risk, compliance risk, and the rest. And the business risk. The business risk approach is an extension of the audit risk approach. So while using an audit risk approach, the auditors focus on their attention on matters that they feel are the most significantly risky to the financial statement, so that they can provide a cost-effective approach. The audit risk approach concentrates on 3 areas of audit. So if you're using the business risk approach, you are concentrating on the issues, the operational issue, the issue that will affect the organization operationally from achieving its intended objectives. Let's question 11. I have the solution here. I want another question. Question that will require us to, recommend 3 audit procedures to validate the accounting estimate. For each of the issues above, evaluate the appropriateness of written representation as a form of audit evidence and describe 2 additional procedures the auditor should perform to conclude on the balances to be included in the financial statement. So let's go through this question. This will be the last question for the day. Then we'll end here. Then we will set another time and continue. So Auntie Nyamiche, can you read the question 12 for us?
All right. Please, can I read the requirement before I read it?
Okay.
Okay. Required. A. Recommend 3 audit procedures to validate the accounting estimate. B. For each of the 2 issues above, evaluate the appropriateness of written representations as a form of audit evidence. II. Describe 2 additional procedures the auditor should perform to conclude on the balances to be included in the financial statement.
Okay, all right. So this is the requirement of the question. Procedures that auditors you perform to validate accounting estimate, IAS 8. Then there are 2 issues in the case. You have to evaluate whether written representation is an appropriate form of audit evidence regarding the 2 issues above. When you are done, you should describe 2 additional audit procedures the auditors should perform to conclude on the balances to be included in the financial statement. So let's see what are the issues in the case. What are the issues in the case? I'll read for us, Sister Nyamiche.
Oliso Private Company Limited has been operating in the manufacturing sector for over a decade. One of its major products is manufacturing equipment, which can reduce toxic emissions in the production.
That's right. Sister Nyamiche, your mic is off. Kindly unmute and read. You have muted yourself.
Oh, I'm sorry.
Okay.
Oliso Private Company Limited has been operating in the manufacturing sector for over a decade. One of its major products is manufacturing equipment, which can reduce toxic emissions in the production of chemicals. The company recently employed a new marketing manager who introduced a series of marketing initiatives. This has resulted in significant growth of the company since the appointment of the marketing manager. One of the initiatives is the warranties that the company gives to its customers.
So take note, the company give warranty to its customers. That's one of the initiatives proposed by the new marketing manager. All right, so let's go on.
The company guarantees its products for 3 years.
Okay.
And if problems arise within the period, it undertakes to fix them or provide a replacement for the product. You are the senior manager recently engaged by Integrity Audit Consult responsible for Oliso Private Company Limited audit. You are performing the final review as required by ISA 520 analytical procedures for the audit and have come across the following issues. Receivables balance due from Obey Company Limited. Oliso Private Company Limited has a material receivable balance due from a customer named Obey Company Limited. During the year-end audit, your team reviewed the aging of this balance and found that no payment had been received from Obey Company Limited for over 8 months. Oliso Private Company Limited, please go up. Company Limited, however, would not allow this balance to be included in the list of balances to be calculated. Instead, management has assured your team that they will provide a written representation confirming that the balance is irrecoverable. Warranty provisions, the warranty provisions statement of financial position is material.
Okay.
The audit team has performed testing over the calculation and assumptions which are consistent with prior years. The team has requested a written representation from management confirming the basis and amount of the provision.
Are you ready? Because if you are ready, we cannot hear you. All right, so let me read. The audit team has performed testing over the calculations and assumptions, which are consistent with prior years. All right, the team has requested a written representation from management, confirming the basis and amount of the provision. Management is here to confirm acceptance of the need to issue this written representation. So you are required to recommend 3 audit procedures to validate the accounting estimate. All right. So what are the procedures will you perform? But let's discuss the content of the question. Let's discuss the content of the question. So the issues in this question are just two issues. So the company have a policy of giving a warranty guarantees to 8 customers. So they give at least up to a maximum of 3 years. So if you buy their product, they will give you a warranty period of up to maximum of. They will give you a warranty period up to a maximum of 3 years. So that is what they are. So within that 3 years, if there is any defect in the product, they may decide to fix them for you, or they may decide to replace the product for you. Now, you are the audit senior. You have came across 2 issues. So the first issue is there is a receivable balance due from Obey Company Limited. The review revealed that the balance is material. The receivable balance is material balance which has been disclosed in the financial statement by Oliso Company Limited. Now, there is an indication that this balance has been due for over 8 months period now, and the company is not paying the balance. And when you decided, so while you are auditing receivables, one way you can do, there are ways you can do that. You verify the ledger balance, you verify the invoices to check that the balances are true. You do external confirmation, you go to the customers to check and see if that is actually the balance they are owing your clients. That's what you do, external confirmation. So you can equally do secularization. That is the external confirmation. You involve that balance, engage the customer to actually confirm that that is the true balance that should be disclosed in the financial statement. Now, when it comes to receivables, the audit work should focus extensively on the recoverability of the balance. How would the company be able to recover that balance? So the audit work should focus extensively on how the receivables balance will be recovered. Now, when the audit clients want to include the balance in the external confirmation, management is saying that no, they shouldn't do that. That they will give them a written representation confirming that the balance is recoverable. So the auditors have not performed any work. The only thing they do the edging balance. They check the balances in the book to confirm that, okay, that is actually the receivables balance. But the work that should focus more on how the balance will be recovered, they have not done that. And they want to do that by doing external confirmation, speaking with what? Obey Company Limited. Management is telling them that no, they should not do that. Instead, they will give them an assurance by a written representation confirming that the balance is recoverable. That is not enough way. That is not enough. And the warranty provision is also material to the financial statement. So the first requirement, you are to recommend audit procedures in relating to accounting estimate. How will you validate accounting estimate? What are the procedures you perform? How will you validate accounting estimate? What are the procedures you perform? So I have possible answers here. I say procedures the auditor should adopt in respect of auditing accounting estimates. Inquire of management how the accounting estimate is made and the data on which it is made. We know accounting estimate, IAS 8. So the work you perform is, first of all, have a discussion with management concerning how they make the estimate and get the data on which they calculate the estimate. Get that data, a copy of that data. That data will serve as an evidence. Determine whether events occurring up to the date of the auditor's report. After the reporting period, provide audit evidence regarding accounting estimate. Review the method of measurement used and assess the reasonableness of the assumption used. Test the operating efficiencies, effectiveness of the controls over how management made the accounting estimate, how the accounting estimate was made. What are the controls that are in place before the accounting estimate was made? Develop an expectation of the possible estimate or a range of amounts to evaluate the estimate. Review the judgment and decisions made by management in the making of the estimate. Evaluate overall whether the accounting estimates in the financial statement are either reasonable or misstated. Obtain sufficient appropriate audit evidence about whether the disclosures in the financial statement relating to accounting estimate and estimation uncertainty are reasonable. Obtain a written representation from management and where appropriate, those charged with governance, whether they believe significantly assumptions used in making the accounting estimate. So this is how you can confirm the audit of accounting estimate. This question, take note of it. Take note of how an accounting estimate could be audited. Take note of it. Now, for the two issues, we are to evaluate the appropriateness of the written representation as a form of audit evidence. So regarding the receivables, I was saying that the written representation is not enough. The written representation is not enough. So the written representation posed by management is intended to verify the valuation, existence, and rights and obligations of a material receivables balance. However, management has refused to allow the auditors to circulate the balance, and there has been little activity on the accounts for the past 8 years. Then there is very little evidence that the auditor has obtained. So auditors, management giving only written representation concerning the receivables is not enough. It will only provide evidence that, okay, actually the receivables has existed. They have a right and obligation to disclose it in the financial statement. They valued it very well. But that does not show how the amount will be recovered. So management refusing not to allow the auditors to include the amount, the balance in the balance, the amount that will be that will be used for external confirmation. That is not in place. The written representation constitutes entity-generated evidence, and this is less reliable than auditor-generated evidence or evidence from external source. However, if related control system operates effectively, then this evidence becomes more reliable. In addition, if the representation is written as opposed to oral, this will increase the reliability as evidence source. So, evidence within, we say that evidence within is less reliable than evidence obtained from external source. Evidence obtained when the internal controls are functioning effective is better than evidence obtained where the controls are weak. But in all, the auditor-generated evidence is the best form of evidence. So management providing only written representation, that is not enough evidence. So overall, this written representation is a weak form of evidence, and there were more reliable evidence options available, such as secularization, but this was not undertaken. So the auditors will have gotten more evidence regarding the account payable when they do the external confirmation. So they cannot rely, or they should not rely basically on the written representation provided by management. If they do that, the audit will be conducted negligently. Now, how should the conclusion be reached on the balances of the receivables? So the second requirement is additional procedure the auditor should perform to conclude on the balances to be included in the financial statement. So these are the procedures they have to perform. So they discuss with management the reasons as to why a secularization requires what review. Ask from them, you want to do external confirmation. You want to put the balance in the form of the secularization you want to do. They refuse. Find out from them, why are they refusing? Then review the post-year-end period to identify whether any cash has been received from the company. You see, I'm saying that when it comes to receivables, the audit work should focus more on the recoverability of the balance. This question, the balance has been due for the past 8 months, and no amount has been received from the company, from Obey Company Limited. So check the year-end balance to see whether if they receive something from the company. Review correspondence with Obey Company Limited to assess reasons for the continued non-payment. Find out from them, why are they not paying the balance? Is it that they are in liquidation, that they don't have financial resources to pay for the debt? Then review board minutes and legal correspondence to assess whether any legal action is being taken to recover the amount due. So review the board minutes to find out if the amount is due for the past 8 months and Obey Company is not paying. So definitely the management of Oliso Private Company Limited, they may have initiated some legal actions against the company to recover the amount. So review their minutes, the minutes of the board meetings, and any legal correspondence to see whether if they have initiated any legal action against Obey Company Limited to recover amount. Discuss with management whether a provision or a write-down is now required. So you find out the balance they have disclosed in the financial, whether there should be a written down, whether the balance should be, part of them should be written off as bad debt. Consider the impact on audit opinion if balance is considered to be materially misstated. So if after your audit you realize that no, Obey Company Limited does not have the liquid resources to pay, then it means that part of the debt should be what? Should be written off as bad debt. So you consider what will be the implication on your audit opinion if the balance is materially misstated in the financial statement. Now, regarding the warranty provisions, the auditor has performed some testing of the provision to obtain auditor-generated evidence. The team has tested the calculations and assumptions. That is fine. None of this is evident from external source. So the very nature of this provision means that it is difficult for the auditor to obtain a significant amount of reliable evidence as to level of future warranty claim. Hence, the written representation, who has been an entity-generated source of evidence, will still be useful as there are few other alternatives. So regarding the warranty provisions, the auditors have performed some form of testing. So they perform the calculations and they test the assumptions that were used. But these warranty provisions, the evidence will have been more efficient, more appropriate. If like the evidence is getting from the external customers, it's warranty they are giving to the external customers. So they should have done some form of external confirmation to get evidence from external source, which will be more reliable. So the conclusion you can do is to review the post-year end period to compare the level of claims actually made against the amount provided. So find out at the end of the year, what were claims that were made by the customers and how much was settled out of those claims. Review the level of prior year provisions with the amount claimed to assess the reasonableness of management forecasting. The reviewed board minute to assess whether any changes are required to the level of the provision as a result of an increase or decreased level of the claim by customers. So we end on this question. Then we have to suggest another day that we will meet. We may do 2 or more 3 questions. We'll do questions on audit reporting. We'll do some questions on the public sector. Then we'll do some questions on corporate governance and other issues. Then I'll discharge you to go and justify your inclusion in the ICAG exam. Any question? But I want to say that the questions I have here, I have provided possible solutions to them. Take your time, read through them, appreciate the issues in the case. While you are done, after reading, try and answer some of them on your own and see how it will go. Any question?
Please, how do we get the documents?
This document is, I think it's even here. Somebody posted it in the chat box here.
So please, can they repost it?
Somebody posted it here. Anna?
Yeah, we've reposted it 3 times here.
Okay.
Somebody posted it here.
Yeah, in our chat boxes there, like 3 times.
Yes, like 3 times, yes.
I still don't get it.
Oh, really? I saw somebody posting it here, so.
It's not showing here too.
It's not showing. Go back, go to the top, go to the chat box. It was posted around 2:16, yes. So it's there. I can see it in the chat box. Just go there and download it, yes. Have you guys seen it? Load the chart to the beginning, you will see it.
So I've tried, but I'm still not seeing it from
Are you on our assurance professional, our main page? Are you there?
Yes, please.
Okay, I will re-forward it to that page so you have access to it. I'll forward it to our main WhatsApp page.
The one with the main WhatsApp page. Okay. Because I'm there. I'm on that page.
Yes, I'll forward it to the main WhatsApp. It's already there. It's even there. It has been posted there. It has been posted there, but I'll forward it there again, so there's no problem.
Okay.
Okay, thank you.
I think I've done that. Yes, I think it's there. I've sent it to that page.
Thank you very much, sir.
All right.
Okay, I've seen it. Thank you very much.
All right. So when are we meeting again? We have to meet one more time. Tomorrow, Monday, Tuesday, I have class. I'm meeting the taxation students. So from Wednesday to Friday or Saturday, I'm available. So when should we meet?
Friday should be fine.
Friday should be fine.
Yeah, Friday.
Okay, that's fine. So we meet Friday from 6 p.m. to maybe somewhere 10 or 9, then we will finish. All right. So we are meeting on Friday. All right.
Okay. Thank you very much.
All right. Thank you too.
This is a bit.